Assalamu alaikum. Welcome to Financial Reporting Revision. This video is going to help you in four different subjects. That is your audit and assurance, advanced audit and assurance, your financial reporting, and your SBR. So take the advantage of this video to cover your entire syllabus for financial reporting, which is not only going to help you in financial reporting but as well as triple A, because in triple A and double A you need the knowledge of your financial reporting. So this video is going to cover from IAS 1 to IFRS 16. Okay, these are short topics from each standard. I have taken only the important parts, but let me tell you again, that does not mean that you don't have to know the entire standard. But since you don't have much days, just few days remaining, so this is going to help you in your quick revision to overcome all the standards in short. So what are you waiting for? Let's start. We are going to start with IAS 1, IAS 2, 7, 8, 10, 12, 16, 19, 20, 21, 23, 24, 27, 28, 32, 33, 36, 37, 38, 40, 41. Then IFRS 1, IFRS 2, IFRS 3, IFRS 5, IFRS 7, IFRS 8, IFRS 9, IFRS 10, 11, 12, 13, 15, and 16. So let's start. Starting with IAS 1, which is presentation of financial statement. So in IAS 1, basically it is on the format. Okay, how a statement of profit and loss or other comprehensive income should look like, statement of financial position should look like. Okay, this also will help you to understand accounting policies, how accounting policy should be selected. Okay, that means financial statements should comply with all the international standards and interpretations. Next, IAS 1. IAS 1 requires comprehensive income to be presented in two ways. One, items that will not be reclassified to profit and loss, items that will be reclassified to profit and loss. So about IAS 1, it's only that much, which is very important. The presentation and how other comprehensive income could be divided into two. That is the most important thing. Coming to IAS 2, which is inventory. The only thing you need to know is inventory could be measured at lower of cost or net realizable value. Okay. Net realizable value is the selling price minus any cost that is incurred to make the sale. IAS 2 says the cost of inventory includes. You should also know what the cost of inventory includes. For example, any cost that you have incurred to purchase the inventory, the purchase cost, right? That's the cost of inventory. If you have import duties that you have to pay, that comes under cost of inventory. Transport cost comes under cost of inventory. Handling cost comes under cost of inventory. Then any direct production cost like direct labor that you have used to make that inventory, yes, it's a cost of inventory. Direct expenses, subcontracted work, cost of inventory. Production overhead and other overheads to bring the product to its location and condition. Now, some costs that IAS 2 excludes: abnormal waste, not part of inventory, storage cost, indirect administrative overhead, selling cost. Okay, and cost could be valued using two methods, that is FIFO and AFCO, first in first out and weighted average cost. Okay, you will not be asked to value, okay, but at least you should know that there are two methods that is there, because the detail and all will be asked in your F level. Okay, if for triple A and SBR you will not be asked to do FIFO or AFCO method, because IAS 2 focuses more on lower of cost and net realizable value. Let's say, for an example, inventory has a cost of 200, can be sold to a customer for 220. Okay, the cost is 30, the cost that is attached to selling. So cost is 200, realizable value, net realizable value will be selling price minus cost, 220 minus 30, which is 190. So the cost should be at 190 because 190 is lower than 200. Okay. Coming to IS 7. IS 7, the important thing is that cash flow is divided into three: from operating activity, cash flow from investing activity, cash flow from financing activity. Okay. Now coming to IS 8. IS 8 covers the three things. IS 8 covers policies, estimate, error. Each thing is dealt separately, they are not together. Policy is done separately, estimate is done separately, errors are counted separately. You have to understand whether it's a policy, estimate, or error. Okay. So IS 8 helps you to select accounting policies. If there is a change in accounting policy, what to do? If there is a change in accounting estimate, what to do? And the prior period error, how to correct. So accounting policies. Okay. Accounting policies means what is the principle based on which you are presenting a financial statement. Okay. Then if there is a change in accounting policy, see, accounting policy should remain same, okay, every year, because it shows that there's a consistency. But sometimes there could be a change. Okay. Whenever there's a change in accounting policy, should be dealt retrospectively. Retrospectively means you have to go back and change the past figure, the previous year figure. That means the opening balance on the retained earnings now has to be recalculated. Why? Because that opening balance becomes a closing balance this year. So opening balance on retained earnings, you need to recalculate based on the new policy, as if the new policy was there from before. Okay. So any comparatives that is there will be restated as if new policy was in force from the previous period. Any change and its effect must be described in the notes to the accounts. Accounting estimate. If there is a change in accounting estimate, see, like depreciation rate, if there's a change in depreciation rate, it's a change in accounting estimate, not a change in accounting policy. Accounting estimates, you have to adjust prospectively. That means you don't go back and change the past, you change the present and the future. In future, you take the new accounting estimate. Okay. And if the change is material, disclose it in the notes to the financial statements. Coming to prior period error. Error could be like maybe you have omitted something or there is a misstatement in the financial statement because of the error. Okay. So IS 8 says you have, this is same like policy. Retrospective you have to change. Okay. Restating opening balance of assets, liabilities and equity as if error has never occurred. Okay. And you have to restate the comparative figure presented as if the error never occurred. This is similar to accounting policy. The only difference is the accounting estimate. Okay. There you don't restate the opening balance and all those things. This adjustment should be disclosed in the notes. Yes, whatever adjustments you make, whether in policy, whether in estimate, error has to be disclosed in the note. Coming to IS 10. Events after reporting period. Okay. Events after reporting period means those events after the statement of the financial position date, before the financial statements are authorized for issue. There's some time difference between that. During that period, that is known as events after reporting period. Two types of events are there: adjusting and non-adjusting. Adjusting are those events for which you have to adjust your financial statement. Non-adjusting, you don't have to adjust, but you have to disclose as a note. And another differentiating point between adjusting and non-adjusting is, for adjusting, okay, there are evidences of conditions that exist at the reporting date. That means that condition has to exist at the reporting date. Let's say a legal case. You have a legal case before the reporting period end. But the result of that legal action you came to know after the reporting period. So that's an adjusting event. Let's say you have taken a new loan, but after the reporting period, that's a non-adjusting event. Why? Because at the reporting period, there were no condition exists that says you are going to take a loan. So non-adjusting means condition does not exist at the reporting date. It happened after the reporting period. You don't have any evidence to say that this condition is there. That is non-adjusting. Okay. Accounting treatment. Adjusting, adjust. Financial statement. Non-adjusting, don't adjust. Just disclose it. Okay. Now, example. There are two examples. Example 1, it's an adjusting event. Example 2 is non-adjusting event. Okay. Same way how I told for a legal provision. Okay. They, by 31st December 2004, they have included a legal provision of 5,000. Okay. In Jan 2005, legal case was settled. So it's an adjusting event, no? And the actual cost was 7,500. So it's an adjusting event. That is from 5,000. Now you have to recognize the provision to 7,500 in the financial statement. Example 2. Company purchased 100% of shares in another company in Jan 2005. This is a non-adjusting. Because by 31st December 2004, there is no mention about that you are going to issue shares to another company. So this is a non-adjusting event, has to be disclosed in the notes to the financial statement. Coming to IAS 12, income tax. You have to understand the scope of standards. This covers both current and deferred tax. But we are going to work on the deferred tax because this is going to be asked, okay, in your SBR. Mostly in SBR and maybe could be a part of AAA. If there is any issue with IAS 12, you might need help of IAS 12 to answer your AAA answer. Now, deferred tax. So deferred tax means this is recognized on a temporary difference between carrying amount of an asset or a liability and its tax base. Tax base means the tax authority, they calculate an amount for an asset or a liability. The way they calculate for tax purpose and the way you calculate the carrying amount is different. That's why that is known as a temporary difference, because only in the current period that difference is temporary. Later on that differences will go. It's not a permanent difference. Understanding? So on that difference we take a tax that is known as deferred tax. Now, temporary difference can either be taxable or deductible. Taxable temporary difference will give rise to deferred tax asset. Deductible will give rise to deferred tax asset. Okay. So if you want to remember this, taxable liability, deductible asset, taxable liability, deductible asset. Remember it like that. Taxable means carrying amount of an asset is more than the tax base. Deductible means tax base is more than the carrying amount. So here, deferred tax, they will give you a percentage of tax. That tax rate only you have to apply to the temporary difference. Okay. Now, sources of taxable. So we are going to go through sources of taxable as well as sources of deductible temporary differences. Depreciation. If there is a depreciation of an asset that is accelerated for tax purpose, it's a taxable. If there's a development of cost, capitalized and amortized in the accounts but deducted as incurred for tax purpose, taxable. Revaluation of surplus of non-current assets, again taxable. Why? See, when there's a revaluation, your carrying amount of non-current asset increases, but for tax purpose they do not change the amount. So carrying amount will be more than the tax base. That's why taxable. In fact, in all these cases, tax base will be less and carrying amount will be more. That's why it's taxable. Next, interest revenue. Interest revenue, okay, you account it for your carrying amount, you account it according to accrual basis. But for tax purpose, they take it on a cash basis. Two different bases, no? Taxable. Why taxable? Because accrual basis you will recognize earlier than the cash base. So you will adjust your interest revenue. That means carrying amount will be more than the tax base. Last one. Temporary differences can arise on business combination if assets or liabilities are increased to fair value, but tax base remains at cost. So in business combination, assets and liabilities are at fair value, but for tax base it remains at cost only. Okay, so once you calculate deferred tax on that, remember that deferred tax also becomes a part of net asset that you have acquired. This comes in your consolidation when you are acquiring a subsidiary. During that time you need this. Sources of deductible. Here tax base will be more, carrying amount will be less. So if there is a loss, okay, in the statement of profit and loss, tax relief is only available against future profit. It's a deductible. That means deferred tax will be recognized in all these circumstances. Next one, intra-group profit are unrealized for consolidation purpose but taxable in individual company. Okay. Third, accumulated depreciation in the statement of financial position is greater than the cumulative depreciation for tax purpose. So if your depreciation is more in your statement of financial position, it reduces your carrying amount and tax base increases. So wherever tax base increases, it's a deductible. Understand this. Next, pension liability. Pension liability recognized in financial statements are only allowable for tax when contributions are made to the scheme. Then research expense are expensed in determining accounting profit but not deductible for tax until a later period. So carrying amount goes down, tax base goes up, deductible. And income is deferred in the statement of financial position but has already been included in taxable profit. Accounting treatment. Okay. See, deferred tax asset is more stricter than deferred tax liability. Understand this. In fact, generally, if you go through all the standards from IAS 1 to IFRS 60, you will notice one thing. That in the recognition of tax, the standard is more strict compared to liability. Why? This is very common sense because we definitely want to show more assets than liabilities. So that's why the standard says no. They don't want us to overstate the asset. That's why they are most trigger whatever asset it is, financial asset, deferred tax asset, lease, right of use asset, whatever it is. There are so many assets under so many standards, intangible assets, non-current assets. For assets, they're more strict compared to liability part. Okay, that's the reason. Like pension asset, pension liability, pension benefit liability, like that. So deferred tax you can only recognize up to the extent, okay, that there are taxable profit in the future. Okay. IS 12 does not permit discounting or deferred tax liability because it becomes very complex. Okay. So you don't have to discount. Even though it's deferred tax, you're going to pay it in the future. You don't discount it. And any changes in the deferred tax, changes are recognized in statement of profit and loss. Unless it relates to the gain or loss that has been recognized in other comprehensive income. Now, let's say for example, property, plant and equipment. Okay. A building has been revalued. So revaluation go according to IS 16, revaluation goes to other comprehensive income. So deferred tax for that revaluation also will go through other comprehensive income. That means it has to be same. If your asset is in other comprehensive income, gain or loss, deferred tax asset or liability, I mean that deferred tax also will go through the same place. Okay. Example. So two example. Example 1. Okay. There's a revaluation of 100,000. Tax is 20%. So deferred tax liability will be 20,000. This is a deferred tax liability, by the way. Why? Because revaluation, you will only adjust in the carrying amount. Tax base will not change. So carrying amount more than tax base means deferred tax liability. So 20% to 100, 20,000 is deferred tax liability. What is the journal entry? Debit tax expense, credit liability, deferred tax liability. Example 2, company makes a loss of 50,000. Tax is 20%. So 15 to 20, 10,000 is deferred tax asset. But you see how they have written. The wordings are, they didn't say recognize deferred tax asset. They told deferred tax asset of 10,000 can be recognized provided there's a taxable profit in the future. If taxable profit in the future is 10,000, they can recognize the entire 10,000 as a deferred tax asset. But if, let's say, in the future the taxable profit is 5,000, then only up to 5,000 out of the 10,000 they can recognize as a deferred tax asset. If there is no taxable profit, zero, you cannot recognize deferred tax asset at all. Coming to IAS 16, this is something I know is very common and it is often liked by students actually. Okay, so first we'll go through cost model, then we'll go through the revaluation model. Cost, okay, initially property, plant and equipment recognized at cost. Cost includes purchase price less any trade discounts or rebates plus cost that is directly involved in bringing that asset to a working condition. Subsequent expenditure on non-current assets is capitalized if it has economic benefit that can bring benefits to the asset, enhances economic benefit to the asset. Let's say if you're adding a new room to a hotel, so through that new room you can generate more revenue, you can get more income from a new guest in that room. So that cost you can capitalize as a part of non-current asset. Second, replaces part of an asset that has been separately depreciated and has been fully depreciated, that is also capitalized as non-current asset. Let's say a furnace that requires new lining. Replaces economic benefit previously consumed. Major inspection of aircraft. Why? Because without this, aircraft will not function. For aircraft to function properly, you have to do inspection after every 1 year or every 3 years or every 5 years, does not matter. But that is a non-current, I mean, that cost is capitalized as non-current cost. They are not expenses. Okay, other than this, others are expenses. Depreciation, we know, to spread the cost of the asset over the useful life of the asset. So IAS 16 says every year depreciation method and the useful life of the asset has to be reviewed because it can change. That means change in accounting estimate, which is dealt according to IAS 8, right? So this is not a change in accounting policy, change in accounting estimate. If assets have parts that have different lives, let's say a building with a rooftop will have a different life. So you depreciate that component separately. Separately you have to capitalize it and separately only you have to depreciate it. Okay, the two examples. Example 1, as I told you, in a room, if you want to go from 20 to 25 room, you can capitalize that expense because your earning capacity will increase from 20 to 25 rooms. So cost of extension, capitalize. Second example, it's you are repainting the room. So repainting the room will not give you any additional earning capacity. So you have to take it as an expense in the profit and loss account, the cost of repainting. Revaluation model. Second model is revaluation. This is optional. You want you revalue, you don't want you don't revalue. But if you choose to revalue, remember all assets in that class has to be revalued. It's not one asset you revalue, the other one you keep it at cost. No. And valuations has to be up to date so that carrying amount and fair value does not differ materially. Okay. And revaluation gain goes through other comprehensive income unless the gain reverses a previously revaluation loss of the same asset. Then it goes to statement of profit and loss. What does it mean? I'm sure most of you are a little confused right now in the second line. See, if it's a new asset that is revalued, very easy, comprehensive income. But let's say that asset was previously, there was a revaluation loss, value went downwards. So revaluation loss is recognized in profit and loss. Okay. So now there's a gain. First there was a loss, now it's a gain the second year. How will you recognize that gain? Entire amount cannot go through other comprehensive income. Only the amount of, see, according to the amount of the previous revaluation loss, until that amount from the revaluation gain now will go to profit and loss. The balance extra remaining will go to other comprehensive income. Okay, next, Revaluation loss, same, goes through statement of profit and loss. But if there was a revaluation gain previously, that part of that revaluation loss will go to other comprehensive income to reduce the previous revaluation gain first. Balance goes to other comprehensive income. Okay. So any extra, beyond that previous revaluation gain will go to other comprehensive income. Depreciation. If there's a depreciation on a revalued, yes, on the revalued amount you have to depreciate over the remaining useful life. Because by the time you came to revaluation, let's say asset was for 5 years. In the second year you revalued. So remaining useful life will be not 5 years now, 3 years. 2 years went by. Okay. Entity can choose to transfer excess of depreciation from revaluation reserve to retained earnings. Okay. If it is done, every year you have to do it. Example 3. Hotel is revaluing his property. Revaluation gain is 250. This 250 will go to other comprehensive income. In 2005, property was again revalued, but this time it went down by 50,000. Revaluation loss. How are you going to recognize? First, there was a gain 250, which sits in other comprehensive income. Now 50,000 loss. So 50,000. Okay, that 50,000 loss, first it will be taken to other comprehensive income. Okay. Previously there was a gain of 250. So that 250 gain will now reduce by the loss of 50,000. So first 50,000 you debit in the other comprehensive income. The remaining from 250 minus 50, the remaining 200 goes to profit and loss. Okay. But if there was not a gain of 250 before, the entire loss of 50,000 will go to other profit and loss. Okay. IAS 19 employee benefit. This is a little bit challenging. Okay. Some standards are challenging like IAS 19, IFRS 9, IFRS 2. Some standards a little bit challenging. Okay. And those challenging standard only you have to focus more, because especially it's more important for your SBR, and questions can come on your audit also from that area, because areas which are more complex has a high chance of having appearing in your AAA or AA. Why? Because risk is more. It will increase your audit risk. Okay. So IAS 19 deals with pensions and other employee benefits. Okay. There are two types of pension scheme: contribution and benefit. Defined contribution pension scheme is a fixed amount of contribution. Okay. Fixed amount. So beyond that, employer has no obligation to pay any further payment in the fund. Okay, in the account. Example 1. So fixed contribution is 5% of the employee's salary. Let's say employee's salary is 100,000. So 5% of 100,000 is 5,000. That means every year 5,000 will be recognized as an expense. Second scheme is defined benefit. We are more focused on the defined benefit because this is our area, which has a lot of things to do. Okay. This is a complex also. Okay. Here, employer has an obligation to pay more than the fixed percentage, unlike contribution. Okay. And this is usually based on the percentage of the final salary. So you see, because it is based on percentage of final salary, you don't know when they are going to retire what will be the final salary. Estimation. You have to make an estimate here. What will be their salary in 5 years or 10 years or when they retire. So, to estimate the fund, actuaries can be, you see, actuaries are the person who values the pension. They are very skilled at this, okay? Because this is a complex area, it's unlikely that an ordinary person will be able to value it, right? So we hire a person and that person is known as actuary, who puts value to this, pension schemes and all. Okay? So they will calculate how many funds today, contributions today you have to make in order to meet your requirements. Okay? So this involves estimating what may happen in the future, what will be the age, what will be the retirement age, things like that. Pension scheme has pool of assets like cash, investments and shares, and a liability also. So and a liability for pension owed to employees when they reach retirement age, because they are liable to the employees. No, from that fund only scheme they have to pay back their employees when they reach their retirement age, and these assets are only used to pay out the pension. How do you measure and recognize? Statement of profit and loss. Three areas will have an impact: statement of profit and loss, other comprehensive income, statement of financial position. Statement of profit and loss will have this path: service cost. Service cost has two things: current and past. Both are there. Both comes under statement of profit and loss. Okay. Also, any gain and loss because of curtailment and settlement, statement of profit and loss. Net interest, statement of profit and loss. Statement of financial position has the net asset or net liability. That means net pension asset or net pension liability. Why net? Because you have to deduct your asset from liability. Either it will be a net liability if liability is more, or it will be a net asset if asset is more. Assets are measured at fair value, liabilities at present value. Other comprehensive, the remeasurement. Okay, the remeasurement gain or loss. We'll go to other comprehensive income. And also return on plan assets. We'll go to other comprehensive income. Definition. There are some definitions which you have to know, like current service cost. What is current service cost? It is the present value of the defined benefit obligation. There's an increase in it. Present value of the defined benefit obligation. Let's say resulting from employee service in the current period. Okay, let's say more employees now came in the company. Now you have to pay them. So you have to pay each one of them. Okay, each one of them will become a part of the plan. So the liability will increase. So it will increase your current service cost. Past service cost. Okay, your liability increases related to employee service in the previous period. Relating to employee service, service has been given in the previous period, but it is arising in the current period. Okay. Let's say past service costs usually arise when there's an improvement in the benefit. So whenever there's an improvement in the benefit, you have to assume it's a past service cost. Okay. Now, curtailment. What is a curtailment? Curtailment is when there's a reduction of the number of the employees covered by that plan. For example, entity closes a plan. So because they close a plan, they are making the employees redundant. If they are making the employees redundant from that plan, the pension that they have to pay will reduce now. Curtailment. It's curtailed. So any gain and loss on that curtailment is a part of a service cost component. Settlement. Settlement when they eliminate when they want to eliminate the obligation for the benefits under that plan. Any gain or loss on settlement is a part of service cost component. All this will come through profit and loss. That means they have settled it today, so there is no obligation on the plan in the future for the benefit. That is the meaning of settlement. They have settled it completely. Net interest. This net interest, how do you calculate? You'll be given a discount rate. That discount rate you apply to the opening net liability asset, not the closing, the opening. Remeasurement component. A remeasurement component may be because of increase or decrease in the pension asset or liability. Okay, because actual valuations are based on assumptions. It's an estimate about the future. That's why there could be changes in that. So because of that changes, there could be a gain or a loss. That gain and loss goes through other comprehensive income, and it is not recycled to profit and loss. Remember in IAS 1, We told other comprehensive income, there are two parts. Items that are reclassified to profit and loss. Items that are not reclassified to profit and loss. This is not reclassified to profit and loss. Example 2. We'll go through this example. Okay. Present value 140, opening. Okay. Fair value, that is assets, 80,000. These are opening balances. Discount rate 4%, current and past service 30, benefits paid 20, contribution 25, present value 200, and fair value planned assets 120. You have been given both the opening and the closing balance of asset and liability. 140, 80, and 200, 120. Now, in your statement of financial position, what do you write? You write the closing net liability. You take the closing liability and minus your closing asset. Take always liability minus asset only. Okay? Because if you take the other way around, you will get confused. So always liability minus asset. When it's IAS 19, always take like that. Liability minus asset. Even for deferred tax like that. IAS 12, always liability minus asset. Take it like that. If the amount is positive, it's a liability. If the amount is negative, it's an asset. That is the easiest way you can remember it. If you take the other way around, you will get confused. So liability, closing liability was 200, closing asset was 120, 200, 120, 80,000. It's a net liability. Liability is more. So in your statement of financial position, only the closing figures will go. That's it. Profit and loss. Three things will go: service cost, and net interest, and we'll see. So service was 30, both current and past. Net interest you have to calculate. How? You have been given the opening asset and liability, right? There also liability minus asset. Liability was 140, asset was 80. 140 minus 80, and discount rate was 4%. Apply that to 2,400. It's a liability, so yes, you will have a positive figure. Liability is more. Okay. Other comprehensive income, only the remeasurement component, which is 12,600. How? We'll see. This is how it is calculated. First, start with net obligation brought forward. That is opening liability minus opening asset. Then service cost you have to add. Then net interest you have to add. Net interest you have calculated previously. Contributions into the plan. Remember, contribution into the plan you have to deduct. This is the fixed method, fixed formula for you to find remeasurement component, and you have to remember it. Benefits into the plan will have no impact. No impact on asset, no impact on liability. So forget about it. Then closing balance, we have calculated it at 80,000. This 80,000 was the balance which went to your statement of financial position also. So the balance 12,600 is a remeasurement. Okay, it's a gain because I can see it's a positive figure. Now, IAS 20, very small standard, easy standard, deals with two things: grant and government assistance. So government grant is like government is giving us some kind of transfer of resources. Okay, because maybe you have in the past you must have complied with certain conditions that is implied by the government, or in the future you're going to comply with it. Government assistance is an action by government to provide economic benefit to a specific entity. Okay, accounting treatment for government grant. We are focusing on government grant. Okay, government assistance we disclose only. Government grant, there's an accounting treatment. Okay, so grant are not recognized until there's a reasonable assurance that conditions will be complied and grant will be received. Now, grants shall be recognized in the statement of profit and loss to match with the expenditure. There are two types of grant, by the way. One is income, one is capital grant, one is income grant. If it's an income grant, okay, let's say income grant is given to subsidize expenditure. So you have to match the cost with the income, the grant, period. Next, let's say grant is given to achieve some non-financial goal. Let's say to create jobs, you are given grant. So whatever the cost you have incurred to create that job will cover that grant. And next is, which is known as capital grant. That is, grant to purchase non-current asset. So this will be recognized over the expected useful life of the asset. Two acceptable accounting treatments relating to non-current asset. For income grant, there is not an issue. Whenever the like during the period when you have incurred the cost, during that time only you are going to recognize the income grant. You have to match the income grant with the cost that you have incurred, same period. Capital grant, two treatments. First, either you can deduct the grant from the value of the asset, that means cost of the asset, and depreciate, or you can show that grant as a deferred income in your statement of profit and loss over the life of the asset. Grants that become repayable. When a grant becomes repayable, it is a change in accounting estimate. So according to IAS 8, you have to deal. Okay. Example 1. Let's say entity receives a government grant of 1.5 million. Okay. To employ people in some low areas of employment over next 3 years. So this is a type of a capital grant or an income grant. It's an income grant. Over 3 years, you have to recognize this 1.5. So 500,000, 1.5 divided by 3, 500,000 you will recognize the 3 years. Okay, as a deferred income. So each year as a deferred income, 500,000. Whatever the cost that you have incurred, the payroll cost, okay, this 500,000 will be offset against that payroll cost during the 3 years. So this 500,000 will be credited. Example 2. This is a grant for non-current asset, 0.5 million to purchase a building. Okay, purchase price of building is 3 million. Useful life of building is 50 years. So tell me how. Two ways you can show it. First way, reduce the cost of the building by 0.5. So it was 3 minus 0.5 is 2.5. That 2.5 divided by 50 years, find the depreciation, which is 500,000. Second way, deferred income. So normally cost was 3 million. So 3 million divided by 50, 100,000. Sorry, 10,000. I'm sorry. 3 million divided by 50 years. So 60,000 is the depreciation. Grant was 0.5. So 0.5 divided by 50. That means income of 10,000. All this 50 years you will recognize. Okay. And in your statement of financial position, there will be a deferred income liability. Okay. That will be reducing each year by 10,000. Coming to IAS 21. This has to deal with foreign exchange rate when you have to translate your financial statement. There are two types of currency, functional and presentation. Functional currency means currency of the primary economic environment in which entity operates. Presentation means in which currency you are presenting a financial statement. Okay. In determining functional currency, you have to see at what currency your sales prices are influenced and the cost, in which cost mostly your currencies are at. Okay. If the company is a foreign owned subsidiary, but it does not have so much of freedom to operate on its own, then it have to use the same functional currency as the parent. And once determined, you cannot change the functional currency. Coming to presentation currency, yes, there can be difference in this among the foreign control and the parent. But make sure when you are presenting, it has to be presented according to the parent's presentation currency, even if the foreign subsidiary is having a different presentation currency to the parent. Okay. Now, individual transactions in foreign currency. If a company is having some foreign currency transactions, you have to translate those transactions into the functional currency of your country. So when you're doing it, you have to see the rate on which the transaction occurred. You can use that rate, or you can use an average rate if it does not fluctuate so much. If you think exchange rate does not fluctuate very significantly, use average rate. They will give in the exam, by the way. They are very clear, so you will clearly understand which rate to use. Now, so for financial position, this is the process. If it's a monetary item like receivable, payable, cash, or loan, you translate at closing rate. Closing rate means the date of the statement of financial position. That at that date, what is the exchange rate? If it's a non-monetary item like non-current assets or investment or inventory, you do not retranslate them. That means they are left at the exchange rate used at the transaction date, called historic rate also. So any exchange differences will arise from what area? From monetary items only. So any exchange differences from monetary items will go to statement of profit and loss. Foreign subsidiaries. Mostly foreign subsidiaries might have their functional currency as their local currency, right? Their local currency and your local currency is different. So you have to translate that one into the parent's presentation currency. Their financial statements has to be translated. When you're translating it, all asset and liability translated to the parent's presentation currency. At what rate? Closing rate. Because assets and liabilities go to statement of financial position. Please understand that way. So financial position, the items that go to statement of financial position, closing rate. Items that go to profit and loss, use average rate. Okay. Goodwill. What about goodwill? Goodwill has a different nature. Goodwill, even though it's a part of an asset, but when you're calculating goodwill, first calculate it at the functional currency of the subsidiary. Okay, then at each reporting date, you will translate into the parent's presentation currency. At what rate? Closing rate, because that is also a part of an asset. That will go to statement of financial position. And income and expenses, because they go to statement of profit and loss, use average rate. So assets and liabilities, closing rate, income and expenses, average rate. Goodwill is different. First functional currency of subsidiary, then closing rate at each reporting date. Now, any exchange differences on consolidation will go to other comprehensive income. Remember, if there's an individual difference, profit and loss, but because of consolidation, other comprehensive income. Okay, until the disposal of the subsidiary. Why? Because when you finally dispose of the subsidiary, profit and loss will go to profit and loss. Any gain or loss will go to profit and loss from other comprehensive income. So it's an example of what? Profit and loss that will be recycled. Gain and loss that will be recycled to profit and loss. Exchange differences can arise from two areas. Retranslation of opening net asset using closing rate. Because net asset every year you translate, no? So opening rate, closing date are different. Second, profit. Retranslation of the profit from the average rate. Profit, you use average rate, right? But remember that profit also goes to statement of financial position. There it will be at closing rate. So two different rates, average and closing. That's the exchange difference. IAS 23, borrowing cost. This is about capitalizing borrowing cost as a part of an asset. But not any asset. Finance cost you can capitalize that is directly attributed to either construction or acquisition of a qualifying asset. Asset needs to be qualified. That means not any asset. If you take a loan for any asset, let's say if you want to buy a stationery and you're taking a loan, you cannot capitalize that. Qualifying asset means those assets which takes a long amount of time to be ready for use. Either for use or either you want to sell it, but it takes a long period of time. Long means more than 12 months. When does capitalization starts? It starts when the construction expenditure starts. And when the asset is ready for use, after that day onwards, you cannot capitalize your borrowing cost any longer. Then any cost goes to statement of profit and loss as an expense. Even if the work is suspended during that time, the cost will not be capitalized. Okay. Example 1. Company borrowed 400 to construct a new office building with an expected cost of 500. Interest rate is 6%. Okay, building will commence on 1st October 2004 and completed by 30th June 2005. So see, you need to count the number of months. When did the expenditure really? It does not matter when you took the borrowing from the bank, okay? You can take any day. But see when the expenditure started for construction of building. It started at 1st of October, ended 30th June. So 1st of October till 30th June is 9 months. Okay, so you have to take 9 months of the 6% of the loan borrowing 400,000, which is 18,000. So 18,000 borrowing cost is capitalized as a part of an asset. Because it is capitalized, you have to depreciate it also. Anything capitalized, depreciate. So depreciate when? When the asset is ready for use. Okay, when the asset is ready for use, from that day onwards only you can depreciate. Coming to IAS 24, related party disclosure. But you need to understand who the related parties are first to disclose. Not everyone is related party. It looks like related party, but not everyone. You need to know that list. There's a list. Either it could be a person who is related or the entity who is related to that reporting entity. So a related party is a person or an entity that is related to the entity who is preparing the financial statement. Okay, so this is a list. First one is a person, either a person or a close member of that person who is related to the reporting entity. If that person has control or a joint control, has significant influence, and is a member of key management personnel of the reporting entity or the parent of the reporting entity, then they are related. Second list is about the entity relating to the reporting entity. This is a very big list. Okay, very big list. First one, if the entity and the reporting entity are members of the same group, which means each parent, subsidiary, fellow subsidiary are related to others. So parent is related to subsidiary, subsidiary is related to fellow subsidiary is related to parent, like that, because they are members of the same group. Second, one entity is an associate or a joint venture of the other entity. That means an associate or a joint venture, they are member of a group of which the other entity is a member, so they are related. Third, both entities are joint ventures of the same third party. So both the joint ventures among themselves, they are related because they are part of the same third party. Fourth, one entity is a joint venture of the third entity. The other entity is an associate of the third entity. Keep the third entity in the middle position. Okay, that third entity as a joint venture has an associate also. So that associate and that joint venture becomes related because they have the same third entity. Understand? Now, fifth, entity is controlled or jointly controlled by the person identified in A. That means it could be a key management personnel, or it could be a person who has significant influence, or it could be a person who has joint control or control. Okay. So any of this, if they control the entity or jointly control the entity, is related. Next, a person identified in A as significant influence over the entity or is a member of a key management personnel of the entity or the parent of the entity. An entity is a post-employee benefit for the benefit of the employees of either the reporting or entity related to reporting entity. That means if entity that has a post-employee benefit, they are separate. Often they are separate from the reporting entity. So they are related to the reporting entity also, and any entity related to reporting entity also, that entity is related to post-employee benefit plan entity. Okay. If let's say reporting entity is only giving that services, post-employee benefit services, then the sponsoring employees becomes related to reporting entity. Entity or a member of a group which is a part provides key management personnel to report, any entity which provides key management personnel to the reporting entity is related. Or they are providing key management personnel to the parent of the reporting entity, they are related. It could be a member of a group also. Let's say a subsidiary is providing key management to another subsidiary or to the parent, like that. Then, so related party means giving any kind of service, resource, obligation. There's a transfer between the two related party, whether the price is charged or not. It's a related party. So if you are from this list, you become a related party and you have to disclose it. Whether transaction is made between you or not does not matter. Disclosure, that's what it is said. Any relationship between parent and subsidiary, whether transaction took place or not, you have to disclose because they are related. Name of the parent and controlling party, if they are different, disclose. Key management personnel, their compensation. What is their post-employee benefit? What is their long-term benefit? What is their termination benefit? What is their share-based payment? What is their short-term employee benefit? Needs to be disclosed. Only for key management personnel, not all the employees in the company. Like CEO or the CFO or the finance director, their compensation package needs to be disclosed. Not the total figure, but you have to divide it. You have to break it up and show the breakup. For related party transaction that have occurred, if the transaction occurred between the related party, two things. What is the nature of the relationship? Is a family member? Is he a key management personnel? That you have to disclose, and the detail of the outstanding balances. Whether any outstanding balances are there or not. What is the amount of that transaction? Because often related party transactions are of a material amount. Okay, they are not for small amounts. Material amounts. So because of this material amount, even in audit, this area can have a material misstatement in financial statement if there's a transaction between related party. That's why focus is more on this area, even from the point of auditors also. Next, so for disclosure should be made for each category of related party. There could be 5-6 related parties. For each category, this things has to be disclosed. Number 1, amount of transaction. Number 2, outstanding balance. Number 3, doubtful debt. And expense relating to irrecoverable debt from them. Example, vehicle has a carrying amount of 10,000, market value is 12,000. But, okay, the directors of the company, they have authorized the finance director to purchase the vehicle for 8,000. At the year end, transaction remain unpaid. So what happened? This is a related party. Why? Because look at finance director. He is the key management personnel. Right? So this 8,000 amount you have to disclose. And it's an outstanding amount. IAS 27. Separate financial statement. Sometimes, okay, this is not mandatory. Maybe the entity elects to prepare separate non-consolidated financial statement. Okay, this usually applies for entities that either has a subsidiary, either has a joint venture, or either has an associate. Because if they don't have none, you cannot go for separate financial statement. I mean, what is there to prepare separate financial statements? You are no more separate. You are individual. You are anyway preparing your own financial statement. But the moment you acquire a subsidiary, or go for a joint venture, or go for an associate, you are having an interest in another entity. That's the reason when IAS 27 you can elect for. So in this case, separate financial statements are presented for each associate, joint venture, associate. So in this case, how do you recognize subsidiary, associate, or joint venture? Either at cost, either at equity method, or according with IFRS 9 financial instrument. Okay, in the separate financial statement. But normally this standard does not come actually. Okay, but just maybe for discussion question or theory they might ask you. But calculation wise and all, I've never seen a question on this. Anyway, coming to IAS 28, very important for SBR for your question number 1, consolidation, right? IAS 28. IAS 28 is for 2 things. It deals with associate also, it deals with joint venture also. Why? They have something in common. They both are accounted using same method. That's why. But first, let's understand the definition of joint venture and associate. Okay. And joint venture, by the way, is a part of a joint arrangement which comes under another standard also, which is joint arrangement. Joint arrangement. There we're going to go through, which comes under IFRS 11. So a joint venture is a joint arrangement. That means both the parties, okay, there could be more than two parties. At least there has to be two, because then it cannot be a joint, no? So two or more, okay, when they have a joint control. That means single person cannot have a control no longer. Okay, it has to be more, two or three or four, whoever they are. Each one of them are having joint control of the arrangement. They have right to the net assets from that arrangement. And there is a separate entity also to conduct this joint venture. Associate is an entity where investor has a significant influence. Okay, significant influence means power to make the decision in operating or financial. But they don't have control, no joint control. If you see in terms of percentage, 20 to 50% is known as associate, significant influence. Less than 20, it is dealt according to IFRS 9, financial instrument, other financial asset or liability. Okay, more than 50%, it becomes a subsidiary. Then you need to consolidate. It is having a control, which is dealt. Control is explained in another standard, IFRS 10. Okay. Now, equity accounting. This is why joint venture and associate are common. Both of them use equity accounting. Okay. Equity accounting is done like this. So, remember, you do not consolidate joint venture and associate, by the way. They are not part of a group. Only subsidiary is a part of a group. Okay. So, consolidated statement of profit and loss will show a single figure only. When you're consolidating, when you're having associate also, joint venture also, subsidiary also, in that consolidated financial statement, you are only showing a single figure regarding associate or joint venture. What is it? Investors' share of the associate or joint venture's profit. Only that figure. And on the statement of financial position, investment in associate or joint venture is shown as a non-current asset. How do you calculate it? Initially, cost of the investment plus or minus post-acquisition reserves. If there's an increase in the post-acquisition reserve, that means profit, you add. If there's a decrease, you minus. The post-acquisition profit you add with the cost. Next, they are not part of a group. You do not consolidate. That means if there is any transaction between parent and associate or parent or joint venture, you don't have to eliminate them. Like how you do it for subsidiary, intra-group transaction, intra-group sales and all. Okay. Example. P purchased 30% of A for 30,000. Okay. A had a return earnings of 25,000. So the moment you see 30%, you should know is an associate. Okay. They have return earnings of 25,000. Year-end return earnings was 40,000. So you can understand it increased from 25 to 40. Okay. Profit after tax was 5,000. How will you account for it? This is a question. So in your statement of financial position, from 40 to 25, sorry, from 25,000 to 40,000, it increased. So the difference you take and apply 30% because associate's percentage plus the cost of the associate, that is 30,000, becomes 34,500. So you will record it as a non-current asset. Investment in an associate within non-current asset, 34,500. Next, in the profit and loss, you will only take the percentage of their profit. But remember one thing, they are only there for 6 months. 1st of Jan they purchased. Year end is 30th June. So only for 6 months you have to take the profit. In statement of financial position, you don't take 6 months. Profit and loss, yes. So 6 months of 30% of 5,000 profit after tax they have given you. So 750. This is the share of profit of the associate. And remember, if there was any impairment, if investment in A was impaired, see, non-current assets can get impaired, right? Intangible assets can get impaired, financial assets can get impaired. Same way, even associate, investment in associate also can have an impairment. If there's an impairment, that impairment needs to be deducted from the share of the profit of associate. If there's an impairment in this question, the impairment is given. Okay, IAS 32, financial instrument. This financial instrument is divided into three separate standards. Please understand. IAS 32 deals with presentation. IFRS 7 deals with disclosure. IFRS 9, the main big standard for measurement and recognition of all financial instrument. Okay, because this is very complex. Again, knowing financial instrument is very good in terms of SBR as well as your audit. Whether you're AA or AAA, does not matter. But because audit risk, business risk is high in this area. Okay, it's always good to focus on those standards more where it has a high chance of having an audit risk also. If you're giving audit paper. Now, IS 32. It says, okay, financial instrument can be classified as a financial liability or equity. If it's a financial liability, it's a debt or equity. Okay, it's a debt if it has an obligation to pay cash. Please understand it this way. If it has an obligation to pay cash or financial asset, it's a debt. If it does not have an obligation, it's an equity. For example, preference share could be both debt and an equity if they are irredeemable. It's an equity if they are redeemable, like loans. Bond, if you are taking, they are redeemable, no? After 3 years, you have to pay back the amount of bond with the interest. That is the meaning of redeemable. So if it's a redeemable, it's debt. Why? Redeemable means you have an obligation to pay the interest and the principal amount. Irredeemable means there's no obligation. That's why it's equity for irredeemable. Coming to compound instrument. Compound means it has both the features of debt and equity in one instrument only. You have to separate them into equity and debt component separately. Example of compound instruments are like convertible bond. Bond you can convert to shares later on, either into fixed number of shares or in cash. Now, so split into liability and equity. First, split into liability component because the balance is then the equity component. Liability component is the present value of repayment. Let's go through this example to understand this better. Because with every standard I've explained, I've given some example with the numbers so that you can understand the standard better. Because unless you don't test yourself with the numbers, you are not qualified enough to say that you have understood the standard. By reading the notes, by reading the rules of each standard, you cannot say you have understood the standard well unless you are able to solve a question which involves numbers. That's the best way to test. Okay, so company issued 10 on 1st of Jan 2004 issued 10 million of 3% bond. Interest is paid in arrear. Loan notes will be redeemed in cash. Loan notes will be redeemed in cash, compound instrument. Okay, interest rate on a similar bond without conversion option. See, whenever you have a convertible bond, okay, when you are separating liability and that means equity and debt, the percentage that you have to use for debt when you're finding the present value has to be the interest rate on similar bond without a conversion option. That means you have to treat it entirely like debt only. That's why we are using a percentage similar to that only. Imagine that conversion option was not there. It was entirely a bond only. So that interest rate, similar interest rate you have to use. That's why 6%. Okay, now split. Okay, so present value is 9.2. How? You got it on 1st of Jan 2004. So for that 1 year 2004, I told you you need that discount rate to find the present value, 6%, right? First year, you can use the discount table, but if you don't know, you can do it manually also. For first year, if you have to discount, it will be 1 divided by 1 plus the interest rate to the power 1 because for the first year. So 1 divided by 1 plus 6%, 1.06 into 3% because they have given you the interest rate. Not the interest rate, I mean the percentage of the bond, 3% bond. So 3% into what? What is the value of the bond? 10 million. So 0.28 plus next year for 2005. Same 10% into 3, but 1 divided by 1.06 to the power 2. It's not 2. It looks like 2. There's a mistake, printing mistake. It is 1.06 to the power 2, not 1.062. So 0.27. Third year also is the same. 3% into 1 divided by 1%. So for all the 3 years, you have to find the interest. Plus, if you see for 2005, the last year, I mean it's 2006 actually. Again, I've made a mistake for the last line. Okay, it is plus 10. Why that plus 10? Principal amount. First 2 years, only the interest. Last year, interest plus the principal, 10 million. That's why you see the amount goes to 8.65. Add all the 3, it will be 9.2. This is how you find. So, double entry will be debit cash 10 million, credit liability 9.2, balance is 0.8, which is equity. Anyway, it has to be credited only. Equity is credited. So, the balance I told you, cash minus liability is equity. For equity, you don't have to do so much of work. Your work is on the liability part. Now, so understand in each financial statement how it will be presented. In profit and loss. Okay. Now, since you know the amount present value of the bond, 9.2, take the 6% now. You are unbounding the interest. This interest will go to profit and loss. So 9.2 into 6%. 0.55. Because 9.2 is a liability. For liability, percentage is 6%. They have given you, right? Without conversion, the interest rate for bond is 6%. So take it. 9.2 into 6 is 0.55. Okay. And the liability will be how much? Only for 31st December 2004 we are talking about, because yes, they will only ask you for 1 year, one particular year. Then you have to know. So it is the amount of the liability 9.2 plus the interest 0.55 minus 10 into 3%, because you have to each year you have to deduct 3% of that bond from the 10. So it will be 9.45. Okay. So next year when you're taking, then opening balance will become 9.45. So 9.45 plus 9.45 into 6% minus 10 into 3%. Third year also like that. So first year balance you can use in the second year balance becomes opening balance for the third year, like that. Equity is not remeasured. Remember, only liability is remeasured every year, not equity. IAS 33. I hope that you people are not getting bored. Okay. I know it's a long way to go because already we have covered more than 1 hour. I think at least it will take another 1.5 hours for me to finish the entire standard, all the standards. IAS 33. This applies to listed companies. Private companies, they have an option. If they want, they can. But if they decided to apply IAS 33, they have to disclose the earnings per share figure. There are two types of EPS, basic and diluted. Basic EPS formula is this: profit and loss divided by weighted average number of equity shares. And weighted average number you have to calculate based on the shares that you've issued in the year. Diluted will be always less than basic EPS. Diluted, the word diluted only tells you, right? Dilution. Dilution means something loss. Something is losing. You're losing something. So this is, you are adjusting the basic EPS. Okay. Here, This could be the reason why your EPS reduces, diluted EPS. Convertible loan stock, share options, shares granted under employee share schemes, rights to equity shares that are contingent upon future event. What is happening? Please understand, in all of these four options, your shares, your number of shares is reducing because you are giving someone else the shares, either the share option, either the shares in the future, either it is contingent upon some future event, or right now you are giving them. Understanding? So you are giving your shares means your shares are reducing. The shares that you're holding. That's why. Example. So let's say entity issued. First, we'll calculate basic EPS. Entity issued 200,000. Okay. On 1st of Jan 2005, 30th June 2005, there was a 1 million share. 2004, 800 was there. They've issued 200, so it became 1 million in 30th June 2005. Profit was 550. Can you understand? It's only for 6 months. After 6 months only they issued the share. Okay. So for 30th June 2005, this will be the weighted average number of share. First you have to calculate that. 800,000 only for 6 months. After that you issued another 200. But you're not going to write plus 200. You are going to write plus 1 million. Okay, into 6 months. Because you have to know at that date what is the number of shares. 1 million. 30th June 2005. So 800 in 2004, 2005, 1 million but only for 6 months. Add both, 900. So profit was 550 divided by that 900,000 share. EPS is 0.61. Now coming to IAS 36, impairment of assets. Very important standard for all the four subjects, AA, AAA, SBR and FR. You will have one question on impairment of assets. So impairment means there is your carrying amount of an asset. Okay, you compare your carrying amount with the recoverable amount of either the asset or the cash generating unit. We'll see at the end of this standard what is cash generating unit. Okay, when your carrying amount is more than the recoverable amount, then it is said that your assets are impaired. So I have drawn it like this so that you easily remember, you can visualize whenever impairment comes, because it is through visuals someone can remember facts better rather than sitting down and memorizing this one is more, take the lower of this, higher of this. So first you compare carrying value with recoverable amount. That recoverable amount should be greater of this two. First, fair value less cost to sell. Next, value in use. Fair value less cost to sell will be selling price minus selling cost. All this will be given, you just have to calculate. Value in use is present value, okay, of future cash flow from continued use of the asset. You have to estimate. That means you will be having a discount rate also here to find the present value. They will give you all the things. They will give you the cash flow for 3-4 years. They will give you the discount rate. You just have to find the present value and compare. Once you compare, okay, then you will know assets are impaired or not. Now, before even know assets are impaired, there are some indicators that gives you a sign that maybe asset could be impaired. Okay, that indicators are could be internal or external. We'll go through that list. Okay, so when there are indicators of impairment, then you have to review. You have to review for impairment. Some standard even says also impairment needs to be reviewed, like IAS 38 says for intangible assets. IFRS 3 says for business combination. Okay, examples of impairment indicator: external. First, competitor actions. When your competitors are high, there are high chances your assets could be impaired. Second, interest rate increases. Increasing in interest rate could affect what area? Value in use. Why? Value in use, you use the discount rate, no, to find the present value of cash flow. Market value of assets falling. All these are external, beyond your control. And changes in business or market where assets are used. Let's say government actions. Because of government actions, now you have to change your business. Internal factors are physical damage to asset, management is committed to reorganization, assets are out of date, assets are lying idle, major loss of key employees, operating loss in business. Now, cash generating unit. It is the smallest identifiable group of assets that generates external cash inflow. Okay. Sometimes it is not possible to do impairment review on individual assets because let's say it's a part of a big business. There are so many assets. How can I say only this asset is impaired? Sometimes you can't say. When something is when you tested an impairment review and it came that there is an impairment, you cannot say because of this, I mean, this individual asset is impaired. So in that case, you have to group, you have to pull all the assets and then do an impairment test. That is known as cash generating units. Because that individual asset will not generate you different cash flow. That asset is a part of a business. That is a supporting factor. But alone, that asset is not giving you any cash flow. So in that case, you cannot do an impairment for that individual asset. Okay. Here also everything remains the same. How individual asset, when individual asset is impaired, the calculation you have done same for CGU. The only thing is this is now CGU, not individual asset. So here also carrying value of CGU compare with the recoverable amount of CGU. Okay. But when you're doing with CGU, you have to take care of certain things, the order of allocation. So when impairment losses are allocated, they are allocated to assets with specific impairment first. Let's say specifically they told you this asset is impaired, this asset is impaired. Then they give you some general assets, list of general assets. Those specific impairment needs to be addressed first. Okay. So this is the order. First goodwill, second other assets you have to allocate on a pro rata basis. Pro rata basis means based on the carrying amount. Okay. But remember, assets cannot be written down below the higher of these three things. Fair value less cost to sell, value in use and zero. In short, it can never be negative. It can never be less than zero because zero will be obviously the lowest amount. Because obviously your fair value less cost to sell and value in use will not be less than zero, no? There will be more than zero only. So whichever is higher of this two, below that you cannot reduce. That is the meaning of it. Let's say fair value less cost to sell is less than zero. It's a negative figure. Value in use is a negative figure. Then assets has to be written down to zero only. Recognition of impairment loss. Assets held at cost. Okay. Impairment goes to profit and loss. It's an expense. Okay. And for revalued, it goes to other comprehensive income. The impairment. But remember, the impairment is charged first to OCI to remove any previous surplus on that asset. If there was a previous surplus, that impairment will reduce that surplus first. That means first it will go through OCI. The balance will go to profit and loss. Okay. This is treated as same way as a downward revaluation of the previous asset. Example, carrying amount of CGU 150, recoverable amount 132. So it shows there's an impairment because carrying amount is more than recoverable amount. Net asset is like this: goodwill 10, property 20, plant and equipment 45, non-monetary 15. There was a 1 star in property. Why? Because property has a market value of 25. So you see, net asset is 20, market value is 25. It shows property is not impaired. Second, net monetary asset 15, and they say it was realized in full. That is also not impaired. So what is impaired? You are only left with goodwill and plant and equipment. Goodwill of 10 and plant and equipment of 45. But first find the impairment. 150 minus 132 gives you 18. So impairment loss is 18 million. Okay. You cannot set them against net monetary asset because it was realized in full. No property because no impairment. So impairment loss first against goodwill, then against property, plant and equipment. So your goodwill will be reduced to nil because impairment loss is 18, no? Goodwill is only 10. So out of 18, 10 will be reduced. You are left with 8. So that balance impairment loss of 8 million will be set against which asset? Plant and equipment in proportion to their carrying amount. As simple as that. Coming to IS 37, a very common standard. I think examiners love this standard so much that it is tested in fact in every paper, whether it is AA, AAA, SBR, FR. Okay, I don't know the reason, but I know. But you know, based on past exam, IS 37 is a very frequently tested. I think every sitting has IS 37. I didn't see any paper where IS 37 is not tested. So, provision definition. It is a liability of uncertain timing or amount. Provision must be recognized when present obligation is there. It is probable outflow of resources will be there, and you can make a reliable estimate. And when time value of money is material, you have to discount the provision also. Specific guidance is there, okay? For future operating losses, there is no provision that you can recognize. For restructuring provision, you can only recognize when two things are there. When there's a detailed formal plan and the ones who have been affected has been informed that there's going to be a restructuring that is going to carry on. Okay. Because when you are making a formal plan means you have an obligation, constructive obligation to carry out the restructuring. Okay. Next, decommissioning provision. This also has to be recognized if there is an obligation to remove the asset at the end of the useful life or restore the site to its original use. Examples like oil rig or nuclear plant. Contingent liability. So provision, contingent liability, contingent asset are three separate things. Provision we have dealt. Contingent liability, okay. So the existence of this will be confirmed only by some uncertain future event. Something has to happen in the future for it to be confirmed that this will take place, but it's uncertain. Today you don't know whether it will happen or not. And it is something outside the entity's control also. So as a result, you do not recognize contingent liability, but you have to disclose. Okay, unless the transfer of economic benefit is remote. That means remote means very far away. That means there is no hope that they are going to be a transfer of economic benefit. Then you don't even have to disclose contingent liability. Otherwise, contingent liability needs to be disclosed. Contingent liability in fact is more uncertain than provision also. That's why provision we recognize, contingent liability we only disclose. Coming to contingent asset, I told you, in any standard, whether it's a defined benefit asset or deferred tax asset or financial asset or contingent asset, whatever asset it is, on asset side standard is more strict. So even for contingent asset, okay, you can only disclose, okay, you do not recognize them if there is a high probability of having an inflow of economic benefit. Then only you should disclose. There should be a high possibility of it. This should be higher than the contingent liability also. Contingent liability, even if you have a low probability, you still have to disclose. But contingent asset is not like that. Possibility of having that inflow should be high enough. Okay. Example 1. This is about restructuring. Okay. So all the employees are informed of it. And by 28th March, announcement was made. Year end was 31st March. So there's a constructive obligation here. You have to recognize a restructuring provision. Why? Before the year end, you have made an announcement. Okay, so cost of restructuring. One cost of restructuring is redundancy. You have to include it. Example 2. Company is publishing about their impact on the environment. So they are taking action to minimize that impact. Okay. Now, on 1st October 2004, company had bought some machine. at the cost of 10 million. Okay, and they have to repair it at 2 million. When it will be 30th September 2007, after 3 years, it will be disassembled and decommissioned. Interest rate representing risk specific to the company is 8%. So here you have to understand whether there's an obligation or not. Yes, there is. Because of the past event, okay, there's an obligation. Because machine was operated in the past, that's why it's now causing damage to the local land. So past event, see, always see for this word, past event has to be there, constructive obligation has to be there. Past event is also there, constructive obligation is also there. Because in a document it says company will take full responsibility for correcting the environmental damage. So here you have to recognize a provision. How initially we'll recognize it? The repair damage was 2 million. You have to discount it for 3 years. Discounted is 8%. So it is 1 divided by 1.08 to the power 3 is not 3. It's not 1.083, it's 1.08 to the power 3. Okay, because for 3 years. So it will be 1.59, the provision. Cost of provision, you debit to property, plant and equipment. Property, plant and equipment as a part of cost of the asset. So this also will form a part of a cost of the asset. It will increase your property, plant and equipment's value. And each year, provision will be unwound to increase the carrying amount of liability, and a finance cost will be recognized in statement of profit and loss. That means what is your provision this year? 1.59, right? That 1.59 you have to multiply by 8% to find the interest, finance cost. Every year you have to keep on doing like that. With the provision, multiply 8%. Example 3. There is a fire in the warehouse, and because of that fire, they are making an insurance claim to recover the warehouse as well as assets. But company did not receive any confirmation from the insurance company. But according to the review of the policy of the insurance, it says there is no reason to believe that claim will not be paid. So in this case, what should you do? You cannot recognize a contingent asset. This is a part of a contingent asset because you are receiving. No, if you receive from insurance something to receive, no benefit, contingent asset, you cannot recognize. Why? There is no virtual certainty that you will be paid. But if there's a probability that the claim will be settled, you can disclose it in the note. IAS 38, intangible assets. IAS 38 says intangible asset is what? Something that you cannot touch and something which is not monetary, but it is identifiable. That means you should be able to gain by selling or using that intangible asset. So initially you recognize it at cost, like property, plant and equipment. Okay. If it meets the following 4 criteria, it needs to meet all the criteria, not one of it. These are the 4. Number 1 has to be identifiable. That means you can separately dispose it from the business. It's not a part of a business. I mean, it's a part of a business, but in case if you want to sell it separately also, you can sell it. It needs to be controlled by the entity. Let's say copyright, patent, because of which you are getting revenues, royalties. Third, it needs to generate future economic benefit. That means it should lead to increasing in revenue or reduction in cost. And the fourth one, you have to be able to measure the cost reliably. Now, if intangible asset does not meet the recognition criteria, it goes as an expense in profit and loss. There are items that do not meet the criteria also, like internally generated goodwill. You do not recognize as intangible asset. Brand, customer list, research, advertising, startup cost, and training. Why? It's hard to put a value for it. It's hard to recognize a value for this. Subsequent treatment is you have to amortize intangible. How for non-current assets you depreciate according to IAS 16, intangible assets you amortize over the useful life. But useful life could be indefinite or finite. If it's indefinite, that means no end, unlimited, then no amortization. How can you amortize when you don't know the useful life? But annually you have to check for impairment review. If finite useful life, amortize. Okay. When it comes to fair value of intangible asset, you have to see whether there is an active market for that intangible asset also or not. See, property, plant and equipment like building, land, if you want to put a fair value, is very easy. There is a big active market. Active market means lots of buyers and sellers are there in that market. So it's easy to get the price, open market price. But for intangible, it's little difficult because they have homogeneous product. Active market means homogeneous product, identical product. Okay. But intangible, mostly they are likely to be using cost model because it's hard to use fair value. It's hard to have how will you put a value for your brand? Because your brand is your brand. It's not homogeneous. You will not have a similar brand somewhere else. How can you put a value? You see, there's not an active market for it. That's why we don't recognize it. Research and development. Okay. This is divided into two. Research is one part, development is another part. Research we expense, profit and loss. Development we can capitalize as intangible assets if certain conditions apply. Otherwise, that is also expensed. These are the criteria. Project has to be technically feasible, asset has to be completed to be used or sold, entity should be able to use or sell the asset, should generate future economic benefit. They should have the resources, whether technical, financial or other resources, and expenditure should be measured reliably. If all the 6 criteria are there, it's a part of intangible assets, otherwise expense. Amortization of development. Remember, because when you capitalize intangible asset, you have to amortize it. Okay, so amortization of development cost will occur over the period that benefits are expected. That is also divided over the useful life of intangible asset. Example. Let's say for a new design work, cost is 100,000. New design work for a new product. They wanted to take it forward over the 2 years. Okay. Now they have spent 500,000 to test another product. Testing was successful and development team is saying they are confident with the product going ahead in 3 months time. So here design work of 100 is a research cost. It will go as an expense. Okay. Because at this stage you cannot say that design will be technically feasible or asset will be used or not. Next, for 500,000 it's a development cost. Okay, and test it has been successful. That means product is technically feasible. And they are also expecting to move the product ahead, which means you can capitalize the 500,000. Now, IAS 40. IAS 40 is investment property, and investment property means something which you are holding it to collect rent or for capital appreciation. That means, let's say land. You're holding a land so that when the value of the land goes up, you are going to sell it. So the difference between the amount that you bought it at and the amount that you're selling is known as capital appreciation. You're going to get a profit on it. So you buy low, you sell high. You buy low, you sell high. Investment property is not one of these 4. Number 1, if owner is staying in that property, it's not an investment. It comes under IAS 16. If you are holding that property to sell within 12 months or in the normal course of business, it is IAS 2, inventory. If property is constructed for third party, it comes under IFRS 15. And if you're leasing it to another entity, IFRS 16. Accounting treatment is initially you have a choice, cost or fair value. Okay. The cost model is same as IAS 16. And the fair value, what about the fair value model? difference between fair value model compared to IAS 16 is any gain and losses on revaluation goes to profit and loss. But in IAS 16, gain and loss on revaluation goes to other comprehensive income. That is the only difference. Example. Company purchased a property of 1 million. Out of that one, land is 400. That means balance 600 is building. Okay. Useful life is 50 years. By the end of that year, property had a market value of 1.1. So from 1 to 1.1. Property is not occupied by the company. That means it's not IAS 16. It has been purchased for investment potential. Okay. If you use cost model, this how it will look like. See, we don't touch the land. Okay. Because they talked about property. Okay. We are more focused on the building. So out of that 1 million, forget about 400 land. Think about the balance 600 building. So 600 divided by 50, which is 12,000 is the depreciation. If the 12,000 depreciation you deducted from the 1 million property, that will give carrying amount of 988,000 in the statement of financial position. Coming to the fair value, 1 becomes 1.1. Okay. What is the gain? 0.1. So this 0.1 gain will be recognized in profit and loss. Remember, no depreciation will be charged. Yes, when you're using a fair value for investment property, there's no depreciation. Okay, there's no depreciation. But if it was IAS 16 or IAS 38, IAS 16, I'm sorry, because IAS 38 is amortization, depreciation will be charged. If company purchase any investment, they have to account using the same basis. IAS 41 agriculture. For agriculture, you have to know certain words. Biological asset. Biological is a living plant or an animal. Harvested product of the entity's biological asset is known as agricultural produce. Why? Because if it's a biological asset, IAS 41. If after the point of harvest, it is treated as IAS 2, inventory. Okay. How do you deal with biological asset? Fair value less cost to sell. You value it at fair value less cost to sell. And each year end you have to revalue. In short, wherever you see this fair value, okay, you have to revalue. Whichever standard, I think majority of the standard has this fair value less cost to sell or fair value, then you have to revalue. Okay, and any changes in fair value goes to profit and loss. So at the date of harvest, agricultural produce fair value less cost to sell. After then, it is dealt according to IAS 2 inventory. Example, there was a herd of goats. Okay, fair value less cost to sell is 1,000. Goat was purchased for 250 on 1st July. That means after 6 months, they have purchased a goat of 250. So fair value will be how much? 1,000 plus that 250. Fair value is 1,450. So you have to deduct 1,000 plus 250. You have to deduct this from 1,450, giving you a gain of 200. Will be recognized in profit and loss. So now we'll be moving. We have done with all the IAS standard. We are moving on to IFRS 1. This standard is for those companies who have adopted IFRS for the first time. Okay. And you need to know one term for IFRS 1, that is the date of transition. Very important. The date of transition is the date, okay, it is the beginning of the earliest period for which an entity presents full comparative information under IFRS standard in its first IFRS financial statement. When you're preparing financial statement, it is also equally important that you give comparative information to your current financial statement. Comparative financial information comes from the previous year. Okay. Now, IFRS 1 requires you to prepare an opening IFRS standard of financial position at the date of transition. This statement must recognize all assets and liabilities according to IFRS standard, not recognize assets and liabilities not permitted by IFRS standard, reclassify assets, liabilities, equity according to IFRS standard, and measure all assets and liabilities according to IFRS standard. Now, what about gain and losses? Any gain and loss that you have incurred while you were adopting to IFRS standard are recognized in retained earnings. Okay. Now, IFRS 2, share-based payment. In your SBR, the standard has a very high probability of occurring. Because this was not in your financial reporting, it is not tested, but your SBR, yes, it is tested. And so in your AAA, it could be asked. Okay. Maybe some knowledge of IFRS 2 will help you while you are planning audit procedures. So IFRS 2, share-based payments, the word share-based payment tells everything, that the payment you make it rather than cash, you make the payment on shares for obtaining goods or services. Now, there are two types of share-based payment. One is known as equity settled. One is known as cash settled. In equity settled, you are giving them share or share options. In cash settled, you are giving them cash. Okay, that cash amount will be based on the share price that day, the day when you are actually making the payment. So cash amount based on a share price, cash settled. The accounting treatment for both are different. If it's equity settled, it's different. Cash settled is different. Let us first start with the equity settled. Okay, but before that, generally understand, when you are issuing a share option to employees, okay, mostly we give share options to employees only. So when you're issuing share options to employees, the fair value of the option at the grant date you have to take. You will be given that fair value and all. Next, for cash settled, that is for equity settled. For cash settled, fair value of goods and services is measured and a liability is recognized. In equity, and equity is recognized, so credit equity, debit expense. Here, debit expense, credit cash. Sorry, debit expense, credit cash, there equity is credited. So you recognize a liability, right? That liability needs to be remeasured at the year end. Every year end you have to remeasure the liability. And any changes in the value of the liability is taken to profit and loss account. We'll see this through numbers, okay? Expense, whether it is equity or cash, there is an expense that an employee is going to incur, right? To give this share options. That will be recognized over the vesting period. Vesting period means the time during which they are going to receive the service. Grant date. Grant date is the date when a share-based payment transaction is entered into. And vesting date, when the date when the other party to the agreement becomes entitled for that payment, whether it's a cash or equity instrument. Example, let's say a company is granting share options of 5,000 due to be vested in 5 years time. Fair value at the grant date is 3. So this is how you are going to calculate. The cost will be 5,000 into 3, 15,000. This 15,000 divided by 5 years. So 3,000 each year you are going to recognize in statement of profit and loss. And each year the cost will be remeasured. Any adjustments taken to statement of profit and loss with a corresponding credit to equity. Credit entry will go to equity. Debit entries in the profit and loss. Credit equity. Why? Because it's an equity based. Next. At the end of year 2, same question. Only 4,000 options will be vested. It is expected out of 5,000, only 4,000. So what will be the total cost? You still have to take the fair value at the grant date only. 4,000 into 3, 12,000. Okay. And this 12,000, you have to spread it over 5 years. So 12,000 divided by 5. But into 2 years, because this is at the end of year 2. So if you go by the new, let's say from year 1 only 4,000 options. Rather than 5,000 is 4,000. So for 2 years, first year, second year. That's why into 2 divided by 5. Okay, for 2 years divided by 5 years. So it will be 4,800. But remember, previously, okay, at the end of year 1, you already recognized 3,000. This year, you are recognizing 4,800. right? It increased to 4,800 the cost, but in your statement of profit and loss, you cannot recognize 4,800. Only the increment. 4,800 minus 3,000. 1,800 only you will recognize. Okay. So let's say there are no changes in the number of shares expected to vest. So this 2,400 will remain till the end of 5 year, from year 3 to 5. Okay, in the statement of profit and loss, 2,400, 2,400, and 2,400. Now coming to IFRS 3, business combination, a very common standard for your question 1 in SBR, because in question 1 we have consolidation. Okay, according to IFRS 3, okay, when there is an acquisition of subsidiary, everything needs to be recorded in fair value. What is that everything? Purchase consideration, because you have to pay them to buy your subsidiary, that has to be at fair value, as well as the net asset that you are acquiring has to be at fair value. Fair value, the definition is the price that you are going to get when you sell the asset. Okay, between market participants. Let's say I want to sell my phone. What is the price? If I want to know the fair value today, I have to go to the market and check the price. What is the price that buyers are willing to pay and sellers are paying at some measurement date? Okay, purchase consideration is measured at fair value. Note that there are 3 types of consideration that could come under purchase consideration. Not everything is just you pay cash and you acquire the subsidy. No, sometimes you pay a deferred cash consideration. Okay, if it's a deferred cash consideration, that means we are going to pay this cash later on, deferred until the future date, not now. So for this, you have to discount it to the present value using the rate at which acquirer could get a similar borrowing. They will give you the rate. You have to discount it. Second could be the fair value of the acquirer's own share. Maybe you are paying them in share. There you have to find the fair value of the own share. Okay, at the acquisition date, whatever the fair value. Third could be contingent consideration. Contingent consideration means if certain outcome is achieved, that consideration will be paid. This is a variable consideration, right? This has to be included as a part of consideration, even if payment is not probable. Okay. Now, you have to know NCI. What is NCI? Non-controlling interest have 2 ways of measuring it. Okay, they will tell you in the exam which method. Either at fair value. Normally, they give you the fair value. So you don't have to calculate fair value. But in case, if you need to calculate fair value, this is how it is calculated. Number of shares that is owned by NCI into subsidiaries share price. Or the second method you have to calculate. They will not give you. Okay, they will only give you the NCI percentage and net asset. So multiply the NCI percentage into the net asset. Okay, fair value of net asset at acquisition. Goodwill. Yes. When you have purchased a subsidiary, you have to calculate goodwill. So goodwill is whatever you have paid to acquire the subsidiary with your NCI over your net asset. That means NCI, fair value of NCI plus consideration minus fair value of net asset at acquisition is your goodwill. Okay. So positive goodwill is a part of a non-current asset, intangible, non-current asset, and even this will be tested for impairment. And any impairment charge will go as an expense in the profit and loss. Then there is a gain on bargain purchase. Gain means when your fair value of consideration is less than the net asset. That means you have paid less than the amount of the asset. That's a gain for you, no? That's a gain on a bargain purchase. You have to pay less for the amount of the asset. So it gives a rise to negative goodwill. Okay, for negative goodwill, okay, you have to often check carefully because it's very rare. This condition is very rare, negative goodwill. That's why you have to check the calculations whether it is done correctly or not. Once you are sure that calculations are correct, it is a negative goodwill only, then negative goodwill is credited to profit and loss. Other adjustments. There are some other adjustments to consolidation. Okay, like interest on intragroup loans, intragroup management charges, intragroup sales purchase, unrealized profit in inventory, unrealized profit due to transfer between two parties in the same group, or intragroup receivable, payable, and loan. Remember, this needs to be eliminated on consolidation. Example: P purchased 100% of S for 1.8. Carrying amount was 1.3, fair value was 150,000 greater than that. So, calculate the goodwill. What was the consideration? 1.8. What was the net asset? Fair value of net asset. Carrying amount is 1.3. They told fair value is 150 greater. So 1.35 plus 0.15, which is 1.5. Fair value of net asset is 1.5. 1.8 minus 1.5, goodwill is 0.3. Now IFRS 5. Non-current assets held for sale and discontinued operation. This is also a very frequent standard which is tested in SBR and financial reporting, as well as even in audit. You might sometimes have to look for it. If it's there, then you have to know the audit procedures and all. So a discontinued means when you are going to dispose it, or it is classified as held for sale. It's a component of an entity. Okay, it's just one branch that you're disposing of, or in one location you are discontinuing the activity, right? So remember, for it to be classified as held for sale, it has to represent a separate major line of a business or a geographical area of operation, and the subsidiary is exclusively acquired with a view to resale. Let's say within 12 months you're reselling, then it passes a form of a held for sale. Sometimes you might have a disposal group also. So IFRS 5 says an asset, non-current asset, or a disposal group is classified as held for sale when carrying amount will be recovered through a sale rather than keeping it for use. Okay, remember, it has to be non-current asset. If it's a current asset, and if you say current asset held for sale, it doesn't make sense, because current assets you will anyway sell, like inventories and all. It is there for selling only, right? It is non-current asset which we talk. Why non-current asset? Because non-current asset we normally don't sell. We keep it in the business for using. We are going to get benefit. Let's say we have a machinery. From that machinery we are going to earn revenue. We keep it in the business for 5-6 years. And then if we plan to sell, then we'll see. Okay. Then it comes into the classification of non-current assets held for sale. Disposal group is a group of assets or a liability which will be sold together in a single transaction. Okay. You're not selling it separately. It's together. For assets to be classified as held for sale, it needs to meet certain criteria. All the criteria needs to be met. These are the criteria. Management has to have commitment to sell. The asset should be in the should be in the present condition so that immediate sale could take place. Sale has to be highly probable, and it is expected that it will be completed within 1 year from the date of classification. Asset is actively marketed for sale and the price is reasonable when compared to fair value, and unlikely that significant changes will take place, and it is unlikely that plan is going to be withdrawn. Okay. Now remember, if all these criteria are met after the financial position date but before the accounts are authorized for issue, you cannot classify the assets held for sale, but you need to disclose. Measurement: how do you measure? You have to measure it at lower of its carrying amount minus fair value less, sorry, carrying amount and fair value less cost to sell, lower of this two. Okay. And assets that are classified as held for sale, you cannot depreciate them, whether those assets are still used by the reporting entity or not. Presentation: how do you present? You can present them on the profit and loss account as a single item, like profit and loss from discontinued operation. You can write this one line. Or gain or loss. Okay, this can include gain or loss on the remeasurement to fair value less cost to sell, or on the disposal of discontinued operation. Okay. IFRS 7, we have covered IAS 32, financial instrument presentation. This is financial instrument disclosure. A very short standard because it is only focusing on disclosure part. Okay. Two categories of disclosure relating to financial instrument. Number one, significance of financial instrument. Number two, nature and the risk, extent of risk. There are two types of disclosure: qualitative, quantitative. Qualitative disclosure describes what is the risk exposure of each financial instrument, management's objectives on managing those risks, and changes from the prior period. Quantitative is summary quantitative data about exposure to each risk, disclosure about credit risk, liquidity risk, market risk, concentration of risk. IFRS 8, operating segment. Okay. In this standard, there are some quantitative threshold that you need to memorize. So for it to be called, remember, an operating segment is a component of an entity. There is a big entity. Out of that, some parts, okay, is known as a segment. It's a component of a big entity, part of a big entity. For it to be an operating segment, three things has to be there. That segment, okay, they should engage in some kind of activity that can give them revenue or cost. Their results need to be reviewed by CODM, Chief Operating Decision Maker, and financial information is available. There should be some financial information that is available. These are the reporting threshold. Okay, if it meets this threshold, you have to report. If they do not meet, you don't have to. One of the following criteria, at least one, they have to meet for it to be reportable segment. We'll divide this into three parts: sales, assets, and profit. And the good thing is, percentage wise, all the three has the same percentage. That means 10% or more. So remember 10% or more rule. If sale is 10% or more, it's reporting. But remember that sale has to include both international as well as external sales revenue. Okay. When you combine all the revenues from all the operating segment, has to be 10% or more of that segment. Second, profit also same way, profit or loss. But profit or loss, you have to do one additional thing. Profit you have to add up separately, loss you have to add up separately. In absolute term, check which one is the greater. Whichever is the greater, you have to take 10% of that amount. Let's say if the profit is more. Profit means all those segments that is incurring profit, you add up. All those segments that is incurring loss, you add up. Check which one is greater. In terms of number, don't check the sign that because this is negative, this is less. Loss will be less than profit. Is not like that. Amount wise. Okay, let's say profit is 300, loss is 400. So loss is more than profit because it's 400. We check in terms of absolute amount, not the signs, positive or negative. So take 10% of that amount and check which amount, based on the amount which is showing the greater amount. Assets also same, 10% or more of the combined assets of all the operating segment. Now, one additional thing is there. When you are reporting, okay, in the reportable segment, at least 75% of the entity's external revenue should be included. So sometimes when you're adding up all the operating segment, it does not add up to 75%, right? You have to meet that rule. Even if according to the 10% rule, they are not meeting the requirement, the criteria are not met, but to make it sure that it reach up to 75%, you have to report those segment also which was not reportable before. You understanding? Maybe the small segments are there which comes under other segment. Now you have to include that also and add so that you reach the 75% threshold. Disclosure. Measure of profit and loss, measure of total assets, and measure of total liability for each segment. IFRS 9, financial instrument. Okay. I know what's coming in your mind right now. Most of you, I know, the word financial instrument itself, the moment you see this word in your textbook, you start hating it. I know that feeling. but I'm sure that at the end of this, you're going to love IFRS 9, because IFRS 9, yes, measurement wise and all is complex, but at least in theory, when you learn it, it's not that difficult. Okay, examiner does not make IFRS 9 very difficult, trust me. In your exam, it's very easy. Yes, in real life, it's very difficult, very complex to measure, and not many might understand it also. But in theory, in your exam, whether it is tested in SBR or financial reporting or AAA or AA, IFRS 9, they only give a small portion of it and they make it easy, quite easy. In fact, the other standard that is tested are more difficult, because we seem to think other standard is easy and IFRS 9 is a difficult, challenging standard. Yes, I know that. Compared to all the standard, IS 1 to IFRS 16, IFRS 9 is the most complex because it has lots of component in it. Financial assets, financial liability, impairment, hedging, derivatives, whatnot. So when you're studying this, break this into small pieces, and I would say study each part at a time rather than studying this standard at a stretch in one go, because it's not going to help you. For example, if you're studying financial asset, just study financial asset today. Financial liability, just study financial liability. Now I know that you are end of that phase, you don't have much time, and this is a revision series, but when you are studying for the next seating, that is September 2023, you can take my advice and learn it like that. But for this sitting for June, you don't have that much time. You have to do it in one go, because it's assumed that you have done your study. Now it's just a revision going through. Just okay. But when you're studying it for the first time, yes, I advise you to study this separately. Financial asset, financial liability, then impairment only, then just hedging separately. Separate it. And once you are done, consolidate everything and just then pick up a question from revision kit and do one question, because you don't know that question will come from financial asset or financial liability or anything like that, and do it after not immediately, after 2 3 days, like the moment you are done with it, just give some gap and then do, so that you can be sure of whether you remember IFRS 9 or not. That's a very best way to test, in fact, any standard, not just IFRS 9. But why IFRS 9 I'm emphasizing more, because it's easy to forget the rules of IFRS 9. Financial asset, you might put in financial liability. Financial liability, you might put in the derivatives or impairment, like that. Rules are very difficult. I mean, it's easy for you to forget when there are too many rules. Okay. So take it easy and do with the easiest question on IFRS 9 first, and then progress to the difficult ones, rather than doing one whole question on IFRS 9, big chunk questions, and making yourself confused and losing the motivation. So you have to keep yourself motivated through the standard, especially. Okay. So I will break it down into small pieces. I will go a little slow also compared to other standard, because other standard, if you see, I was going quickly, right? I was going a little bit faster. But this, I will slow my speed so that you can catch up with me. And if you're studying this for the first time, then it's going to be very beneficial to you, because this standard is not explained like this in any other YouTube video. I don't think so. If they will just give you a quick snapshot, or and it is not helpful for the beginner. Maybe for the advanced level people, yes. If you are a beginner level, this might not help you. So I will go a little bit basic also, and little bit slow also. Maybe some of you might find it little slow, especially for the ones who are very advanced in this and who knows everything, who are pro in this. You can skip this part and go to the next standard, it's fine. Or you can watch this in the 2 times of speed, 2x. Choice is yours. But I'm assuming that majority of you have problem in this standard. They're struggling with it. Okay. And I'm assuming you're beginners also. Okay. So, okay, let's start. Financial instrument. The word financial says, just think financial in terms of money, something to do with money, cash. Okay. So here, after everything we are going to discuss, whether asset, liability, impairment is to do with cash, money. Okay. So financial asset, financial liability. Financial instrument is divided like that. First, we'll go through financial asset before we move on to financial liability. Financial asset is divided further into 2 parts. Okay, financial asset means, definition is when you have a right to receive cash, no matter whatever means it is. objective is you have to receive cash. You have the right to receive cash. Okay. This is further divided into two parts. Investment in equity, investment in debt. Because if you invest in equity also you can receive cash. How? Through dividends, through shares. If you have debt, let's say you are giving the debt. It's not you are taking the debt. Many people confuse investment in debt with financial asset. No, it's you are giving debt to someone. It's like you are giving loan to someone. If you are giving a loan, you have the right to receive cash or not. Yes, so it's a financial asset for you. For them, it's a financial liability. Okay, so first we'll go through investment in equity because this is easy, short, but investment in debt, there are many parts to it. Investment in equity when you are investing in ordinary share of another company. That is a financial asset to you because you're going to receive cash through it. Okay, and normally measured at fair value through profit and loss. It is normally measured through profit to fair value and loss. Keep it simple. So investment in equity, investing in shares, measured at fair value through profit and loss. But there is an option. You can elect to measure this through other comprehensive income also. Fair value through other comprehensive income. But to do that, conditions are there. See, whenever you are given an option, remember, nothing comes free of charge. With that option, some conditions they will give you. Provided you meet the conditions, you can apply for it. Condition number 1. Equity instrument must not be held for trading. See, anything held for trading, understand it like this. Anything, any standard held for trading, profit and loss. Not held for trading, other comprehensive income. In this way, you will remember it better also. Try to visualize, okay? So, equity instrument not held for trading, other comprehensive income. Makes sense? And choice is irrevocable. Irrevocable means later on you cannot change. You have to stay with this only. If it is fair value through other comprehensive income, it is fair value through other comprehensive income only. And when you are making this choice, remember, it is upon the initial recognition of the asset. For example, asset has to be recognized such way that fair value through other comprehensive income. Initial recognition only. Later on, you cannot change the choice. And normally, if you see normally, equity instrument, like if you're having shares in another company, do you hold it for trading? That you're going to hold for shares today and now you're going to sell it to someone else? No, right? Normally, you keep it for a long term. So that later on, if share price of that company increases, you can get the benefit, right? Normally, it is not held for trading. Not like debt instrument. Equity instrument, normally, it is not held for trading. But if it's held for trading, then it is fair value through profit and loss. Then you cannot make this election. This is only for investment in equity. Okay, that's it. Coming to next. Under financial asset only. We didn't move to financial liability yet. So don't confuse this and that. Investment in debt. You are giving a loan. It could be loan, you are giving a bond, any kind of debt. But you have the right to receive cash. This can be measured in 3 ways. Okay. Number 1, amortized cost. And the other two, what could be the other two? By now you should know. Fair value through profit and loss, fair value through other comprehensive income. Amortized cost, okay. And most of the debt instrument, let me tell you, it is measured at amortized cost only. Okay. So this could be measured at amortized cost if conditions are there. Okay. In fact, IFRS 9 has lots of conditions, even to apply some method. Not like IAS 16 or IAS 38, how you say cost and fair value model. Here, conditions are met, you choose the model. Okay. So first, financial asset. Okay, look at the business model. For debt, you have to see the business model. Based on the business model only, you will select the method to measure. If the business model, you are holding the financial asset and your aim is to collect the money. Okay, that means you are not selling it. You are keeping that financial asset till the end. And the amount that you are getting is only principal and the interest of that amount. That means the loan that you are giving, only the amount of the loan and the interest on that loan, that is only the amount that you have right to receive. Then is amortized cost. Take this for example as a loan. If you are giving a loan on some specified day, you have a right to receive cash, the amount of loan and the interest on that loan, no? Same way. And you are keeping that loan also. You are giving that loan, let's say you are giving a 3 years loan to someone. In this 3 years, you are keeping that loan only. Okay. So it's an amortized cost. Next, fair value through other comprehensive income. Here also condition is there. Number one, same business model you have to see. The difference is in the business model here. If the objective is to collect the contractual cash flow and sell that financial asset later on. You see, sell that financial asset means you are selling that loan or bond or whatever the debt is. Debt could be any type, no? You are selling that. Then fair value through other comprehensive income. In the earlier one, amortized cost, you didn't sell the financial asset. Your objective is to collect contractual cash flow. Here you are selling it also. And second criteria is same, interest and the principal amount. Third, fair value through profit and loss. Anything that does not go through other comprehensive income or amortized goes through fair value through profit and loss. Okay, this is simple. So for debt instruments, you have to remember the business model, whether objective is to keep it or keep it and sell it. Sell the financial asset later on. So if it's neither of two, it does not go in any of the two, the third option. Now, financial liability. Over with financial asset, move on to financial liability. And by the way, examples of financial assets are like your debtors, trade receivables. Okay. Later on, we are going to go through trade receivables. Okay. Financial liability examples like your payable because you have an obligation to give cash to them. Okay. So here, measured at fair value through profit and loss. Financial liability. Most financial liabilities are measured at amortized cost. So here also similar to financial asset, debt instruments are financial assets, same way. Fair value through profit and loss, most are measured at amortized cost. And for financial liabilities, we don't have fair value through other comprehensive income, only this two. But there is one more rule in IFRS 9 that says for financial liability, okay? Let's say based like financial liabilities to be measured at amortized cost, okay? But IFRS 9 allows it to measure it at fair value if measuring it at fair value helps it to eliminate or reduce an accounting mismatch. Maybe this you will not understand, but there are questions on this. Okay. Let's say, for example, the change in the fair value of financial liabilities due to a change in credit risk that is recorded in other comprehensive income. Okay. And any balance of the change in fair value is recorded in profit and loss. So if it is recorded in other comprehensive income, okay, due to credit risk, other comprehensive income. But if the balance of that change, apart from the credit risk, any change in the fair value will be reported in profit and loss. Okay. So if you record that financial liability at amortized cost now, rather than fair value, there's an accounting mismatch. Because the balance of the change in the fair value of financial liability, you are recording in profit and loss. Whereas financial liability, you are measuring it at amortized cost. It doesn't make sense. So keep it at fair value in one place only. Okay. This is we are talking when the financial liability changes due to credit risk. Okay, credit is something beyond the normal change we are talking about. Normal fair value change and credit change in financial liability due to credit risk is two different things. Okay. In SBR, we have explained this. In my SBR lecture, you can go back and check. We have explained, we have done questions on this. To understand this better, you can go there and check. Coming to impairment of financial asset. We are not going, we don't impair financial liability. We only impair assets, okay? So impairment of financial assets. How we impair intangibles and tangibles? Same way. Financial assets also impairs. So the next is impairment of financial asset. Some definition you have to know. Credit loss. What is a credit loss? Sometimes it happens, no? You are entitled to something, but you're actually receiving something else. So there's a cash shortfall. Okay? That is a credit loss for you. Sometimes your customers might not be able to pay you the amount. Maybe they are bankrupt or something. So it's a cash shortfall. Next, there are two types. Lifetime and 12-month expected credit loss. Lifetime means all the possible default event over the expected life of financial instrument. 12-month means default event possible within 12 months of the reporting date. Okay. Now, loss allowance. For financial asset, yes, you have to recognize some kind of loss allowance. It's not 100% that you're going to receive exactly the amount that you have the right to receive. That's why you have to recognize a loss allowance. Okay. Especially, it is only recognized for debt instruments, not for equity. Because when you invest in shares of another company, there is no doubt, there is no risk in that. You are anyway going to receive. But when you're giving a loan to someone, there's a risk that they might not pay you back. That's why loss allowance only for debt instruments in financial asset. And also debt instruments which are measured at amortized cost or fair value through other comprehensive income. Only these two, not fair value through profit and loss. No. So it's very limited. If your credit risk, okay, does not increase significantly since the initial recognition, that means on the financial asset, then your loss allowance is equal to 12-month expected credit loss. They will give you this figure in the exam. What is 12-month expected credit loss? If the credit risk on the financial asset increases significantly, that means your customer in the worst position, for example, they're not able to pay you at all, then lifetime expected credit losses. Any adjustments to this loss allowance? Sometimes it happens that this year it's 12 months. Next time it will be lifetime expected credit losses. Sometimes lifetime becomes 12 months. Conditions improve also. It's not all time it keeps getting worse and worse. So that time any changes are done through profit and loss only. Okay, if there is an increase in loss allowance, statement of profit and loss is debited. If there is a decrease in loss allowance, it needs to be credited in the profit and loss. How do you measure this expected loss? It has to be unbiased and it has to be based on some probability. It has to be discounted to present value and based on information from past, future, and current. Receivable. I told you receivable is a financial asset. So for loss allowance for receivable, what do? This is specifically for receivable out of the financial asset, specifically for receivable. When we talk about financial asset, it includes all financial asset. Okay. But when they specifically talk about receivable, you have to mention this standard. Loss allowance for receivable should be at an amount equal to lifetime credit losses that do not have a significant financing component. What is significant financing component? Significant financing component means you are not taking an advance payment from them. That means there is no advance payment for you to be sure that they are going to pay or not. You don't have any security from them. No advance payment, nothing. They have not deposited anything. Usually you see if something is taken on credit, they will tell you some amount you need to deposit us or some security. If nothing is like that, that is not a significant financing component, payment in advance. So if you have not received anything in advance, nothing has been deposited by them, nothing at all, okay? There is no security for you. So in that case, makes sense, right? Lifetime credit losses. Receivable has to be equal to that. Derivatives. Next is derivative. Financial instrument could be derivative also. Okay? But it needs to have these three characteristics. Number one, The value of that derivative changes based on the following 5 things: interest rate, security price, commodity price, foreign exchange, or similar variable. We have studied this somewhere. Derivatives are done in some standard, some subject. What is it? AFM. If you have done my AFM course, you will understand this better. We have done a model there, Black-Scholes option pricing model, which says the value of the option changes based on 5 variables. That is this only. But you don't have to know in depth for your SBR or your FR or your audit. But yes, in financial management, you have to know it. So if you have done AFM, you will understand this very better. Derivative is nothing for you. Investment is very little or no, and it is settled at the future date. And it is measured at fair value, and it goes through profit and loss. But all the derivatives which are not part of hedging arrangement, it is not there to hedge. Okay. Now hedge accounting. To hedge. See, if it's not hedging, fair value through profit and loss. If it's hedging, we have hedge accounting. So everything has some standard under it. Hedge accounting, I've highlighted for you, made it bold, needs to have 2 things: hedging instrument and an hedged item, the amount on which you are hedging. Through instrument only you are hedging, no? And this hedge accounting is optional, by the way, it's not compulsory. That means any gain or loss in hedging instrument will be offset by gain or loss on hedged item. See, it's opposite. If you are making a gain in hedging instrument, you're going to have a loss in hedged item. That's how it's offset. You cannot have gain in 2 places and loss in the 2 places. One has to be gain, the other one has to be loss. Other one has to be loss, the other one has to be gain. It's like that. It works like that. Basically, it's offset, gain and losses of each other. That is known as hedge accounting. It needs to meet certain criteria to apply hedge accounting rules. First, there should be a relationship between the hedged item and hedging instrument. If this relationship is not there, if they're not offsetting gain and loss of each other, you cannot apply the hedge accounting. Second, there has to be a formal documentation which needs to say that this is the hedged item and this is the hedging instrument. Relationship has to be effective. Effective means the loss has to go. Gain and the losses has to wipe off each other. And let's say hedged item is a focused transaction based on some focused that they want to hedge. Let's say in the future, anything can happen, no? Conditions might be favorable or unfavorable. You want to hedge that condition. So in that condition, transaction must be highly probable. If transaction is not highly probable, then there's no need to hedge. Use hedge accounting. Accounting treatment. There are 2 paths for hedge also. When you are hedging, one is fair value hedge, because you know fair value keeps changing. So you want to hedge that. Other one is cash flow hedge, because cash flow that you're going to receive or pay. Because I told you, financial instrument has to do with cash. Everything with cash. That's why cash flow hedge also we have separately. And fair value, because anyway fair value change, because most of the financial instruments are at fair value. So we have to hedge that. So it makes sense, right? So at reporting date, hedging instrument at fair value. Okay. Carrying amount of the hedged item also will be adjusted for the change in fair value. What about the gain and loss? The gain on loss on hedging and the loss or gain on the hedge will be recorded like this. This is very important place. This is where the difference comes for cash flow and fair value hedge. Difference is where do you record them? The gain and loss. If it's a fair value, it goes through profit and loss in most cases. Gain and loss. But remember in equity instrument, we told it can go through other comprehensive income. Right? So if the hedged item is an investment in equity, because investment in equity also you measure at fair value only. Remember investment, see, go back. investment in equity, we don't measure it at amortized cost. It's always fair value only, either through profit and loss or either through comprehensive income. But it is at fair value. So there, if the fair value changes, it is going to have an impact on you. That's why you have to hedge that. So investment in equity, that is measured at fair value through other comprehensive income. Most of the time it is this only. Then the gain and loss also has to go through other comprehensive income. Gain and loss of hedging that investment in equity. Coming to cash flow hedge. Okay. Here, gain and loss will go to other comprehensive income. But everything remains the same. Hedging instrument will be remeasured to fair value. There also hedging instrument will be remeasured to fair value. Those things are same, but the places where you're going to record are going to be different. Cash flow, other comprehensive income. Okay. But however, if the gain or loss on the hedging instrument is greater than the loss or the gain on the hedge item, sometimes there could be a difference. Then the excess gain or loss on the instrument must be recognized in profit and loss. Understand this. It is on the instrument that we are focused, not on the hedged item. If the instrument is having a greater, okay, gain or loss does not matter. Compared to hedged item, instrument is greater. Whether gain or loss, that excess needs to be recognized in profit and loss. Excess only. Okay. Now, IFRS 10. And make sure that you comment below about how did you like IFRS 9, whether you are able to now, are you in a better position to understand IFRS 9 or not, so that I can make more videos on IFRS 9 maybe for the next sitting for SBR and for other subjects. Coming back to IFRS 10, consolidated financial statement for SBR, another important standard, and even for audit if you are told to do group audit. Okay. Consolidated financial statements are only prepared for subsidiaries because there only you have control more than 50%. Control means sometimes they might not give you percentage. Sometimes they might ask you whether a company has a control over another company or not. That time you have to go through this three component. Number one, power. Whether they have the right to exercise majority of voting right. Number two, exposure, whether they have the exposure or rights to variable return. Could be positive or negative, does not matter. Third, ability to use the power. See, they might not use the power, it's their choice, but at least they have the ability to use that power to affect the investor's return. Because then only it is said to have control, no? If they don't have the power to affect someone's return, then what sort of control is it? So, normally more than half of the ordinary shares, that means more than 50% is control. If percentages is not given, you go through this. Okay. IFRS 11, joint arrangements. One part of it, joint venture, we have covered in IAS 28 when we were doing associates. The other part is dealt in this standard. So, joint arrangement means the word joint says parties having joint control. Two or more parties having joint control. Okay. Now, joint arrangement can take two forms. One is joint operation, other is joint venture. Joint venture and joint operation, there are differences. If it's a joint operation, it is dealt according to IFRS 11. If it is joint venture, equity method, we have solved it in IAS 28. First, finish joint operation. Joint operation means they have no separate entity, unlike joint venture, where they have a separate entity. Another difference, joint operation have rights to assets and liabilities. Okay, joint control over the rights to the assets and obligations for the liabilities. Joint venture have the right to the net asset of the arrangement. See the difference. Joint operation, assets and liabilities. Joint venture, net asset. Okay, these are the two differences. So, we are talking about joint operation because joint operation is only dealt according to IFRS 11. Here, each party who is having a joint control will recognize their share of assets, their share of liabilities, their revenue, their expenses from that joint operation. It could be any percentage. One person might have 30%, other person might have 20%, person might have 40% accordingly. Joint venture equity method. IFRS 12. Disclosure of interest in other entities. For to have IFRS 12, you should have interest in other entities. That means you should have some kind of control or joint control or significant influence. If you don't have, then how can you apply IFRS 12? That means you should have some subsidiary or joint venture or an associate. Okay, and you are going to disclose that. So here it's a very small standard. So it requires disclosure of this thing. How the group is made, who is the subsidiary, how many who is the parent, how many subsidiaries do they have, how many associates do they have, all the details will be there in the standard. Second, the NCIs of the group, the details of them. Third, the risks. What are the risks of each entity? Because if you're having a control over another entity, there'll be some risk. If you're having a joint control, also there'll be some risk. If you're having a significant influence, also there'll be some risk. IFRS 13, fair value measurement. Okay, this is a single standard which gives a guidance on to measure fair value. Normally fair value is given to you, we take it, but wherever it is not taken, wherever you have to calculate fair value, use IFRS 13 rule. But remember, be cautious of two standard that does not use the rule of IFRS 13. That is IFRS 2 and IFRS 16. Why? I mean, this question is not given anywhere, but tell me why. Because it's very difficult to use IFRS 13 for them, for this two methods. We'll see why. Okay, we'll keep it at pause for now. We'll go through it. Fair value definition already I've explained, I think in some previous standard. So I'm not going to take time again to explain. You can see the definition. We are more focused on the way it is calculated. Okay. It is based on the hierarchy. It is based on some hierarchy. Okay. So our important focus is on the inputs that we are taking to measure fair value. There are 3 levels that is said we use in order to measure fair value. Okay. Level 1, level 2 and level 3. And preference is given to level 1 because level 1 is the most safe and level 3 is the most riskiest out of all. Level 2 is moderate. Level 1 means you are using exactly the same price that is quoted. You have an active market for identical assets and liabilities. Okay. Level 2, it is little less reliable than level 1. That means there is not an active market for identical assets or liabilities, but similar. Because it's similar, remember, you have to do some adjustment. In level 2, some adjustments you have to do. Level 1, exactly you can take it. For example, public shares that is quoted on stock exchange. Level 1, you can take the price. Level 2, you have to do some adjustments. Okay, like intangible assets. Might not have an active market. But for similar, you can look at the similar like that and take the value. Level 3, there is no input to observe. You have to estimate your own thing and measure. For example, cash flow forecast. You estimate some cash flow, find the present value. So present value of the cash flow, that is a level 3 input. That is only suggested when you are not able to get through level 1 and level 2. Last resort. So if you take the share-based payment and leases, tell me, we'll go through each level. It's always top to bottom, level 1, 2, 3. You should not first give priority level 3, 2 and then 1, okay? Let's start with share-based payment. Can we go through level 1? No. How? Is an active, you have your own shares, you are going to give share options to your company's employees and all. How can you find an active market for it with identical this thing? Is impossible. It's not there. I mean, not impossible, but it's very difficult because your company share price will be different compared to other company share price. Level 2, identical. No, because other companies might not give share options. Even if someone gives share options, there are things they might give at different time, or the it will be different. There will be lots of differences. It's hard. Okay, level 3. See, level 2 we can use when adjustments are only little. Majority of it are same, only some adjustments, but not when only little things are similar and so many adjustments you have to make. Then level 2 you can use. Level 3, can you do a cash flow forecast for your share-based payment? It's very difficult. That since you see it's very complex, that's why they told IFRS 13 is not applicable for IFRS 2. Same for leases also. But you don't have to obviously go through the reasoning. That's my explanation, so that later on you don't ask me this question that, ma'am, why are we not using it for leases and all. Now, IFRS 15, revenue from contract. Very common standard. No matter whatever the paper is, very, very, very common. Even for audit also very important. So first, quickly we'll go through the 5 steps to recognize provision. Recognize revenue. I'm sorry. First, contract has to be there. Second, contract means agreement between two parties. One party will have rights, one party will have obligation. Two, performance obligation you can separately identify. Performance obligation means what is the promise that they are making to the customer. For example, they are promised to supply a building or supply some services. That's a performance obligation. Sometimes within one contract there may be 2-3 performance obligation. Third, transaction price. Okay, amount that entities are expected to receive based on the satisfaction of performance obligation. Any amount that you have collected on behalf of third party, let's say you're collecting tax, so tax on your sales are excluded, they are not part of transaction price, and this transaction price and everything are decided the time you have signed the contract. Fourth, transaction price you will allocate to the performance obligation. Let's say there are 2-3 performance obligation. You are giving a, let's say for example, you are giving a computer and also 12-month service. So for when the transaction price was discussed, they only give one transaction price. They didn't say for this much it will be price, for that much this will be the price. You have to allocate between the two, the total transaction price. Step 5, and this allocation will be based on the selling price of each of the performance obligation. Okay, finally recognize revenue when a performance obligation is satisfied. Here also, two things: are you satisfying it at a point in time or over a period? Mostly for product it is at a point in time, and for services it is over a period of time. Okay, so if it's over a period of time, one of the criteria they have to meet. First, customer is receiving it also and consuming the benefit at the same time as the entity performs. One example is me teaching you right now. This is a performance obligation which I'm satisfying over a period of time. Why? The moment I'm teaching, you are getting the benefit. There is not a time delay. B, entity's performance creates or enhances the asset that the customer controls as the asset is created or enhanced. Okay, for example, work in progress. If something is in work in progress, why is it in work in progress? So that you keep on working on it and you improve the performance of that asset up to the point then you can sell to the customer. For example, building, let's say you are constructing a building. It takes 4-5 years to build a building, for example, let's say. So in the first 4 year, it will be work in progress until you don't complete that product, that building. Entirely you don't construct. All the first 4 years, work in progress, work in progress, work in progress. It will keep on improving. First year work in progress is 20%. 20% work you have completed. Next year it will be 40%. Third year it will be 60%, like that. So those type of, then if it's that type of environment where you have work in progress over a period of time. Third, entity's performance does not create an asset with alternative use. That means there is no alternative use. You are creating that, let's say I'm creating a building. specifically designed for my customer. It is customized. You cannot use it for an alternative purpose. So usually when it is customized, they usually make it. I mean, they don't have any other market. They will not make it for a loss, no? Imagine if they're making it and then they're not selling it, for which they have a right to receive the payment. Even if the customer later on uses that product or not, does not matter. They will get the money. They will take the money according to the work that they have performed. I mean, work that they have completed. Whatever till date the performance that they have completed, for that they have a right for payment. So if these three conditions are there, one of it is met over a period of time. Okay. So when you're recognizing revenue, it is based on the progression towards the performance obligation. Let's say 50% or 30%, or they will give you. Next, if it is not over a period of time, then it is at a point in time. At a point in time is very easy. The moment customer gets the control of that asset, you recognize revenue. Example, construction contract, very good example to recognize revenue over a period of time. Okay, let's say there's a building that you have to construct on 1st of October 2001. Price was 4 million, but they have a condition that if the construction is completed by 30th September 2002, they will get a bonus of 1 million also, apart from that 4. And building is specially designed for B holding. Okay, but A believes chances are that they might not meet the bonus criteria. Okay, so now A is measuring the progress to completion in terms of the contract cost. See, there are two ways you can measure the progress. One is input, one is output. Input means you look at the cost, how many costs you have incurred up to date. Output means what is the result that you have occurred. Output, what is the output that you have achieved. So they are going, in this case, they are going by the cost input method. So contract cost that they have incurred up to that date. Okay, as a portion of the total contract cost. Total contract cost is 2.5 million. Okay, if in case B cancels the contract also, A is liable to receive that amount, the work that they have completed till date. Okay, and by 31st December, the amount of cost that they have incurred is 0.25. So out of 2.5, 0.5. Okay, but still they have a doubt over that 1 million bonus. Okay, so accounting treatment for it. First, you need to understand whether this is the revenue from contract also or not. This is, there is a performance obligation. Performance obligation, what is the performance obligation? To construct a building. Only single performance obligation. Okay, so 4 million is a fixed consideration. The other 1 million bonus is a variable. Okay, so remember, for variable consideration, you can only include them in the transaction price if it is highly likely that later on it will not change. That means once the uncertainty is known, the situation will not be reversed. That means it will remain as a consideration only. If there is chances like that, then only. If there is a doubt that once the uncertainty is known, that means let's say later on you don't achieve the objective, then bonus is not receivable. No, you cannot, according to the rules, according to the condition, if you don't satisfy the condition later on, that means the bonus that you have recognized right now, you have to de-recognize it. No, so if that condition applies where you have to de-recognize later on after recognizing, you cannot recognize it as a transaction price. This is for variable consideration. But if there is no change, that means later on you actually meet the condition. So even if you have recognized the variable consideration as transaction price today, it will not change later also, because you have met the bonus criteria. Then only you can recognize. But because you see A is uncertain, so you cannot recognize the 1 million. So only 4 million is your transaction price for the contract. And if you see, the building also is very bespoke nature, bespoke, very customized. Okay, with the doubt expressed by A. So now we'll recognize this revenue based on the cost that they have incurred. Okay, and we'll see whether it is a point in time or over a period of time. This is over a period of time. Why? Asset has no alternative use and they have a right to payment for performance completed to date. So this is satisfied over a period of time. Now we'll calculate that. Cost that they have incurred is 0.5, total cost is 2.5, percentage is 20%. They have completed. So 20% on the 4 million transaction price is 0.8. This is the revenue. Very simple. So when they are recognizing, they are going to recognize a receivable of 0.8. Why? Remember, they have not yet received this. They are going to receive it in the future. They have the right to receive this. That's why receivable. Next example, non-refundable deposit. This is at a point in time. Okay, this revenue. This is about airline selling their tickets directly to customer via website. Okay, and remember, once they have paid, it's non-refundable. Okay, you have to pay it in full. When you are booking for the flight, you have to pay it in full, and they are non-refundable. They will not pay you back. So here also, performance obligation is one, to provide a flight. It is satisfied at a point in time when you make the payment. That means when the flight has been taken. Okay, so when flight is taken, you recognize revenue. Last standard, IFRS 16, leases. Here you need to this is also a contract. Previous one was also a contract. So you need to understand when you're reading a contract whether that contract is a lease or not. First step is that. Then only comes about recognition, measurement, disclosure, presentation, everything. Identify a lease. Okay. So lessees. Who are lessees? Lessees are the person who have taken the lease. Lessor is the person who have given the lease. Okay. So lessee is going to recognize the asset and the liability for all the leases that they have taken, except two things. If the lease is of short term, that means less than 12 months, and if it's of minimal value, amount is not so much. So either this or that, you don't recognize lease. Otherwise, all the leases you recognize. So when you're reading a contract, see to it whether is it a contract for service or a contract for lease. If it's a contract for service, IFRS 50. Now, lease will have this type of contract. Okay, it will give you the right to use an asset for a certain period of time for which you have to pay to the lessor. Now, lessee accounting. There are two types of accounting in IFRS 16, lessor accounting, lessee accounting. And also at the end, we are going to go through sale and lease back. Okay, starting with lessee. Lessee accounting is, first we'll go with the exceptions. Okay, we told that if it's less than 12 months or of low value, we don't recognize an asset or a liability, but still we have to recognize it somewhere, no? Somewhere it has to be recognized. We cannot just omit it like that. So that those lease payments you recognize in the profit and loss, their expenses. Okay, this is lessee's recording. Now we are going for the major thing. Apart from this, for all the other things, lessee is going to recognize two things: lease liability and a right of use asset, because he's using the asset. He has the right to use that asset. Lease liability because he has to make the payment when the lease starts. Okay, right of use asset initially at cost. So this will include your lease payment, lease liability, plus any lease payment made at or before the commencement of the lease. Because anything you made after the commencement of the lease comes as an expense. Okay, they will not come as a right of use asset. Even any direct cost, you will take it as right of use asset. Later on, right of use asset needs to be depreciated. So you depreciate them. And any impairment loss, you deduct it. Lease liability, you take the present value of the lease payment. Most of the time they will give you this present value of lease payment, so you don't have to worry about it. Now, the carrying value amount of the lease liability is increased by any interest charge. See, lease liability, okay, take like any liability, you have to pay an interest on that, no? Same for lease liability. That's why lease liability will increase by the interest. That will be recorded in profit and loss. If you make any cash repayment, your lease liability will reduce. Now, lessor accounting. Lessor accounting, you have to identify whether the lease is a finance lease or an operating lease. If it's a finance lease means you are transferring all risks and rewards of owning that asset to the lessee. These are some key indicators to say it's a finance lease. Number one, ownership of asset is transferred to the lessee at the end of the lease term. Number two, there is an option to purchase the asset at the end of lease term, or they can continue to lease it. That means the lessee can continue to lease it for less than fair value. It's a finance lease. Third, lease term is major part of the economics life. Fourth, present value of the lease payment is substantially all of the asset's fair value. Now, if it's a finance lease, how will you account for it? De-recognize the asset. Why? You have given the asset to lessee, no? Think from the point of lessor. I'm selling it. I'm giving it to lessee. So I will de-recognize the asset from my side and recognize what? A lease receivable, because you are going to get a payment from lessee now. So lease receivable. Yet you have not received, you are going to receive. That's why lease receivable you are going to recognize equal to the net investment in the lease. Net investment means the present value of payment. Any interest income, you are going to receive the income this time. So recognize that, okay, in the profit and loss. If the lease is an operating lease, it's very easy. You spread it over the profit and loss, over the number of the lease term. It is recognized in profit and loss. Okay, it's a lease income now because you are getting. Lessor always gets the income, lessee is the one who has to pay. Now, sale and lease back. This is a little complex in the whole of IFRS 16, okay, but I will make it easy for you, don't worry. Sometimes what happens is you sometimes have an asset, let's say, okay, you sell it and you take it back again, but when you're taking it back again, you are taking it under lease. So you are selling it and lease back. You're selling an item and then using it under a lease or lease back rather than entirely so it's not sale and purchase, we are selling and lease back. So in this you have to see that sale whether it's actually a sale or not. Accordingly your accounting treatment will differ. If it's a sale, treatment will be something else. If it's not sales, treatment will be something else. That means you have to see according to IFRS 15 whether you have satisfied a performance obligation or not. If in your exam they are testing you IFRS 16, okay, you can be confident that they are not going to test your IFRS 15. If the main objective is testing IFRS 16, inside they will not test IFRS 15. Don't worry, they don't do that. They only test one major standard. If they are testing IFRS 15, that's a different thing. There they will test. But if the question is on IFRS 16, sale and leaseback, they will not test IFRS 15. That means examiner is very kind enough that they will give you. That means they will write that statement that this is a sale or it's not a sale. It makes your work very easy. Your focus is then on the accounting treatment only accordingly. So you don't have to see whether performance obligation is met or not. You don't have to do any kind of test or something. That means you don't have to calculate the revenue. Revenue will be calculated and given to you if it's a sale. Okay. This is a table. If you know this, you have understood everything of sale and leaseback. This table is enough. That's it you have to know. Because we are almost towards the end of this. I think after this we have one example and that's it. So first we'll go with if the transfer is not a sale. Okay, now the seller becomes the lessee and the buyer becomes the lessor. That means the one who has sold, he's using it under lease back, so he's the lessee. Okay, if the transfer is not a sale, continue to recognize the asset. Why? It's not a sale, no? You have sold it and you have again taken it on lease back. So you are still using the asset. So continue to recognize the asset. Then, what you have to recognize? See, it's a sale and a lease back. You're using it under lease. So then you recognize a financial liability equal to the proceeds received. That means whatever the, see, when you're selling it, okay, you have received something, no? First time when you forget about lease back, first is sale. Sale has to take away, then only lease back. So when you have sold it, something you must have received, some proceed, okay, and then you have leased it back. So once you have leased it back, you recognize a financial liability. That financial liability is equal to the proceed that you have received when you have sold it first time. Sold and leased back. So equal to the proceeds received. Why financial liability? Tell me. You become a lessee. You become a lessee. If you become a lessee, you have to pay, no? You have an obligation to pay to your lessor. Obligation to pay means as a financial liability. Just now, I think few moments back, we finished IFRS 9, telling financial liability. Same knowledge you have to apply. Anything obligation to pay cash, financial liability. That's why you recognize a financial liability. Amount to equal to what amount? Proceeds that you have received. Because you cannot recognize it as a revenue. Sale did not take place, no? That's why that proceed received is equal to financial liability. For buyer, even if they have bought, because it's not a sale, seller is still recognizing asset. You cannot recognize the asset. So do not recognize the asset, even if you have bought it. Because it's not a sale. Again, anyway, the lessee is taking it back from you. So do not recognize the asset. You instead recognize the financial asset. See, financial liability for someone is a financial asset for you. Because you are going to get the payment from lessee, no? That's why you have to recognize financial asset according to what you have paid. Transfer proceed. Once this is clear, if a transfer or sale is more easier than this, simply seller de-recognize the asset because you have sold it. Instead, normally if transfer is a sale, normal lessee rules apply. Lessee accounting. That is, recognize right of use asset. You have taken it as a lease. But when you are recognizing it as a right of use asset, there's a fraction that you have to do. Okay, we'll do that fraction later on. Next slide has a question, right? As a proportion of assets, previous carrying amount that relates to right retained. Previously you had some rights that you retained. So according to the carrying amount of that proportion, you have to recognize a right of use asset. We'll see now. And recognize a lease liability. And because it's a sale, obviously there will be profit and loss on that disposal. So recognize that. Who has to recognize? Seller. He has sold it. He will recognize profit and loss. Whereas the lessor, on the other hand, he will account for the asset purchase because he bought it, if it's a sale. And he will go by the lessor accounting normally because he's a lessor now. So, example, N is selling property to F for 20. Property had a carrying amount at the date of disposal of 7. N enters into a contract to lease the property back from F. Once they have sold, they want to lease it back from F for 5 years. Present value is 5.7. Now, they have told in the question itself that this is a sale. They have satisfied the performance obligation according to IFRS 15. It's a sale that have took place. Okay. So because it's a sale that have took place, normal lease rules apply, lessee and lessor. But only difference is area that you need to work is on the right of use asset. I told you have to calculate a fraction. So when you're recognizing a right of use asset, It is at the proportion of assets previous carrying amount that relates to rise retain. This is how you have to do. Remember this always. This will help you in any lease questions. Because this is an area which is frequently tested by examiner. IFRS 16 is another standard. In IFRS 16, especially this one, sale and lease back. If you see, present value of lease payment is 5.7 divided by 20. So it's always the present value of lease payment divided by the amount that you have sold into the carrying amount at the rate of disposal. That is 7. This is always the fraction is like this. Maybe the figures will change, but it remains the same, which is 2 million. So right of use asset is 2 million. Lease liability will be how much? Will be 5.7. They have already given you. So double entries like this. Debit cash 20 million because you have sold. Debit return of asset to credit lease liability 5.7. What is the balance? I mean, okay, property, plant and equipment you have sold, credit that also 7 million. The balance is profit. It's a balancing figure. There's a profit on disposal of 9.3. Your debit side has to be equal to your credit side. That's how you get the balance always. Okay. Remember, if it's not a sale, then what? If it's not a sale, has to continue to recognize the asset, but they have to recognize financial liability also. Now, of how much? Of the 20 million proceed that they have received. So that's it. I've covered all the standard from starting from IAS 1 to IFRS 16. I've tried to explain everything briefly, the important points under each standard, and my job is over. And now it's your job to pick up questions from your revision kit, no matter whatever the subject is. You can use it from the point of financial reporting. I don't know how you're using it, or you want to use it for your AAA, AA, SBR, whatever the subject is. This is going to be useful for all the papers. So make sure that you make the maximum use of this revision, and do share it with your friends who maybe this might be a last minute help for them if they have not covered the entire textbook, right? And best of luck for your exam tomorrow.